have a robust labor market. That's a key fundamental pillar to the U.S. strength and the U.S. outperformance.
We've been saying that the labor market have been holding up pretty well.
Very hard to argue that the labor market is retightening.
The U.S. is doing considerably better than the rest of the world.
We are seeing some signs of loosening in the labor market and deceleration in growth.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It's Lisa's favorite line. Let's get you to the weekend.
100%.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now on a 3-day winning streak on the S&P 500. Your scores look like this. Equity futures totally unchanged on the S&P. On the Nasdaq 100, we're negative not even 0.1%. The main event, 8:30 Eastern Time. The jobs report. The estimate in our survey, 175. The high, 240. Lisa, the low, 105.
The question I have is, what's the potential risk for markets? A downside surprise or an upside surprise? I'm going to just venture to bet that if it was 260,000 on a headline print, it wouldn't cause some sort of wild freak out about a reacceleration of the labor market. What you might get is discussion about how random this number is, the upside surprise that always happens in January because of seasonals. But this is a market that has moved beyond the overheating narrative to concern about potential cracks in the labor market.
Dead on. We've taken some heat out of the story so far this week. We saw that in jobless claims, just a little bit softer, but no drama. Saw that in job openings, saw that in the ISM as well, with prices paid falling back. Laurie Logan of the Dallas Fed, in no rush to do anything. What if inflation comes in close to 2% in the coming months? Well, that would be good news. It wouldn't necessarily allow the FOMC to cut rates soon, in my view.
She's talking about neutral rate being around where we are currently. She is on the hawkish side of things very clearly. At the same time, what's interesting to me is how little this moved the market. People basically looked at this and said, yeah, okay, one hawkish member sort of trying to put out this possibility. They'll move according to the data, and they're not giving any forward guidance. Right now, people are looking for cracks. They're looking for downside surprise, and it is no longer the Fed. It is that 10-year yield that Scott Bessent has squarely highlighted.
40 basis point move off the highs of last month. We're also waiting for the policy changes. So here we are. Bear with me. The president's tax plan. End taxes on tips and overtime. New cuts for Made in America products, extend TCJA back from 2017. All familiar with those plans. Expand state and local tax deduction, got it. Then they threw in this yesterday. End the carried interest loophole. Did not see that coming.
Did not see that coming, as well as ending breaks for sports team owners. These are two new provisions that the president is throwing out there that he never mentioned on the campaign trail. All I would say for this, for both of you, if this Republican majority passes closing the carried interest loophole, I will buy dinner for everyone. I do not see this happening, but he's coming out with an even more ambitious tax plan.
What's shocking to me is he is surrounded by people from Wall Street, from the private equity industry, from the private debt industry, and this would target them. This basically says you can no longer pay the lower tax and treat some of your carried interest as simply long-term gains. So all those private equity managers, this is something that one estimate has potentially raising some $12 billion over 10 years for the IRS. Sounds great. I just don't see the support for it in the people he's surrounded by.
That's a man who's not running again. There are plenty of people in Congress who are running again. And to your point, I wonder how that complicates things. But I wouldn't be surprised by anything at this point. Would you be? We had an opportunity to do that under the Democrats. Didn't happen. Why? Kristen Sinema. So I wouldn't be surprised by anything. Let's see what happens.
And what's so interesting is actually the Democrats ran on that. They said we want to be able to make sure we are taxing billionaires and those Wall Street elite that have special tax breaks. And yet, when push came to shove in the 11th hour, because of Kristen Sinema, they weren't able to do it. And they had control of the House, the Senate, and the executive branch. Now Trump also has that same level of control. People I'm talking to say, don't even ask me about this. It is not happening. But you're right. Maybe anything is possible, especially he's not running. But you know who might be? J.D. Vance.
Stay tuned. You're just worried about the dinner bill now. Equity futures on the S&P just about unchanged. Coming up this hour, we'll catch up with Chris Verrone of Strategas ahead of the payrolls report, Kim Wallace of 22V Research on Trump's tax priorities, and Shweta Khajuria of Wolfe Research on Amazon's week outlook. We begin this hour with stock steady as traders await US payrolls at 8:30 Eastern Time. Chris Verrone of Strategas, a Baird company, looking to the bond market and writing, we take some comfort in 10-year yields decisively breaking below 450. This is the debate of the day. Do lower yields support cyclicality or suggest growth is slowing? Chris joins us now for more. Chris, good morning. Good to see you.
Great to be here, John.
Does the equity market help answer that question?
Yeah, I think so. And we can look to kind of the impulse of leadership to get an idea of how the market feels about this growth versus inflation debate. And I think that's the big question as we kind of settle in 4 or 5 days past the initial tariff announcement. The debate that we're having in every client meeting, is it a hit to growth or is it something that restokes inflation down the line? If it's the latter, I would not expect to see oil on the lows. I would not expect to see energy stocks continuing to surrender relative leadership. So I don't lean to the inflation camp here. I lean more towards the growth camp. I think we're okay at the moment. Financials still lead, credit's still okay, but I do want to be vigilant here on the growth side, particularly with bonds. If we're sitting here in a few weeks and say 2-year yields are, back under 4.05 or 4%, you begin to wonder, what is the market trying to message to us about where growth goes from here?
Do you think the conversation changes as we start to talk about taxes a whole lot more? The sequencing was interesting here.
Yeah.
Started with trade, started to shift back to taxes. Does the conversation in the bond market shift too?
Well, if you remember during Trump 1.0, the debate around what would ultimately become the tax cuts, that was when cyclicality and growth were at their most pronounced. It's actually when the tax cuts passed in late 17, early 18 is when cyclicality began to roll over. And you begin to get this very odd divergence between bond yields were still going up, but cyclicals were underperforming. That is never the combination that you like to see. I don't think we have that here yet, but I do want to just be on guard for it.
Given the fact that there has been this rally in the long end, does that give you real confidence that this shift into that equal weight trade, that shift away from big tech, is sustainable, has legs?
Well, let's make a couple points here. I'd say number one, we were sitting here a month ago with on payroll Friday with yields roughly at 475 or 480, and we had a relatively hot number. And here we are a month later, and yields are under 450. So it seemed like we did a lot. A lot was priced in at 475 or 480. I would be surprised if we got them back above there. I've generally been more sanguine on bonds. I think ultimately 10s probably settle in the 415, 420 neighborhood. Now, what does that mean in terms of the market's tone or messaging on growth? I think there's two things we need to watch here: financials and credit. It's so consistent for the last 18 months. Financials have been your leadership. Credit conditions have been remarkably benign. So if something is changing, I think that's ground zero. That's where we got to spend our attention.
Right now, it seems like people are positioning more, girding for a potential growth shock, as we've been saying. How asymmetric, and this is a point that Priya Misra made, and she's going to be on the show later this morning, how asymmetric is this market positioned, asymmetrically, in terms of a downside surprise being a much more significant driver of market activity than an upside surprise?
Well, it's funny. Again, it was only 3-4 weeks ago where people were extremely worried about bond yields going to 5, 515, 525. Just think of how quickly the plot changes in this game that we all play
fun,
every day. Listen, the last 2 years, 10-year yields have averaged about 415. We're near that average right here. I think on balance, that's probably better for equities than it's not. I think you start to get the long end under, say, 4%, 390, 380. Then you begin to really wonder why. What's the messaging there on growth? But I would say, just with respect to big tech or some of these big stocks, I don't think it's yields that are the big story. I think dollar yen is the big story here. And you think about the last 10, 12 years. All this money that's moved into the top of the market, big cap tech, the mega cap stocks, it's been coincident with this yen carry. What changed in July, right? When did dollar yen peak? It peaked July 10th. When did tech relative versus the S&P peak? Also July 10th. These two are tied at the hip here. And where's yen this morning? 151, 152. So something has changed here. All the other yen pairs, as I'm sure that you've noted, have all rolled over. This, I think, is the bigger story. Does the east to west flow become less pronounced when dollar yen is off the playing field?
Let me jump in. 4 weeks of yen strength.
Yeah.
Noted the same thing. Also in Europe, there's corresponding pickup in European equities. The DAX is up by 10% year to date. Year to date.
Yeah.
It's not even mid-February. Is the European equity story part of that call as well?
I remember a few weeks ago, I was sitting, I think I was watching maybe your program, and Christine Lagarde was in Davos. And I think she used the phrase that she was peak pessimistic on Europe. And I'm like, wait a second. We have a pessimistic central banker. At the same time, the Euro banks are making new highs. The Euro industrials are making new highs. European credit's benign. I want to be a buyer of pessimistic central bankers when the market tells me that I should. So I I like Europe here. We have liked Europe here. In the very near term, it's probably tactically overbought. It's been a remarkable start to the year here. But as long as these banks are involved, I think you stay long Europe. And also just note, all these luxury names, which everyone says are so tied to China, they've all bottomed. They've all turned. So should we entertain the idea that maybe the Chinese economy has found some trough here? I think so.
Do you entertain this idea if Donald Trump puts tariffs on European Union products?
I entertain the idea, or I embrace the idea that I know I don't know, right? Number one, first rule of our work, we know that we don't know. I value the market's opinion over my own, and certainly the market knows the possibility of all these things, yet Europe carries the flag of leadership to start the year, so I think there's some messaging in that. And remember, we've had a reset in Euro USD, we've had a reset in sterling, we've had, frankly, look at these European short rates. We've had a reset in European short rates. That sounds more constructive for the equities than not.
So do you think the market is taking all of Trump's threats when it comes to the European Union as that's just it? Threats and warnings, he wants a deal. He's not actually going to put the walls up.
I'll let the experts kind of make that decision of ultimately where this goes. I think what's most important is, we have this delicate balance right now. On one hand, we have this tariff threat looming. I think on the other hand, you have weaker currencies and lower bond yields throughout the continent, which generally stoke stocks. So I kind of think the market's more focused on the latter at this point. And I think the message from the leadership in Europe is really constructive here. Discretionary better than staples. Banks very strong. Seems like the market's okay with that.
Final question. We catch up with the NEC director, Kevin Hassett, a little bit later on this morning, following the jobs report. What do you want to know from the administration? What's your number one question right now?
Yeah, I think the big question here as we kind of look out over the next 4, 5, 6 months is what is maybe the pain threshold for maybe some of the policies relative to the economy. I think the bond market is going to be my judge on that. We go back to Trump 1.0. I think what was misunderstood was there was always this view that there was a Trump put on the market. Well, there were some pretty deep corrections
2018
in Trump 2018. Certainly even 2019, the market was kind of beginning to come under some pressure. So I'm a little bit skeptical of this idea that there's some immediate Trump put. S&P's down 3 or 4%. We'll see. I'm skeptical of that.
Hey, Chris, it's good to see you.
Great to see you.
Chris Verrone of Strategas, a bad company, with some real advice for Europe. Fade Lagarde, not my advice. His advice, I'm paraphrasing. Equity futures on the S&P. You're for real, right? Fade Lagarde. You want to reiterate that?
It's buy Lagarde, right?
Buy Lagarde.
Pessimistic central bankers. You buy pessimistic central bankers.
But you fade her view?
Yes.
Yes, okay.
I actually wrote that down. I want to be a buyer of pessimistic central bankers. I want to have a T-shirt made of that, and I would like to wear that on Monday. So, yeah, I'll credit you at the bottom.
Thank you.
Perfect. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Shares of Amazon are falling nearly 3% in the pre-market. The company reported better than expected revenue and profits for the holiday season, but its guidance for the current quarter fell short. Plus, despite plans to invest $100 billion this year in AI infrastructure, Amazon is warning it could still face capacity issues in its cloud computing division. President Donald Trump held a meeting with U.S. Steel CEO David Burritt at the White House amid growing questions over the company's future. That's because former President Joe Biden blocked Japan's Nippon Steel takeover bid, and Trump has also said he's opposed to a sale. Trump is due to welcome the Japanese Prime Minister today. And Trump has tasked his Vice President, J.D. Vance, with overseeing the future of TikTok in the U.S. Punchbowl is reporting that Vance will work with National Security Advisor Michael Waltz. On his first day in office, Trump issued an executive order giving TikTok a 75-day extension to find a buyer in the U.S. or face a ban. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next on the program, President Trump's tax agenda.
This will be the largest tax cut in history for middle-class working Americans. The president is committed to working with Congress to get this done.
That conversation up next with Kim Wallace of 22V Research, live from New York City on this Payrolls Friday. Good morning. Live from New York City on this Payrolls Friday, the estimate in our survey, the median, 175. The number drops in about 2 hours and 15 minutes time. Equity futures going absolutely nowhere going into that, pretty much unchanged on the S&P. Likewise in the bond market, the 10-year 4.4283. This could all change at 8:30 Eastern time. Under surveillance this morning, President Trump's tax agenda.
These are the tax priorities of the Trump administration. No tax on tips, no tax on seniors' Social Security, no tax on overtime pay, renewing President Trump's 2017 middle-class tax cuts, adjusting the SALT cap, eliminate all the special tax breaks for billionaire sports team owners, close the carried interest tax deduction loophole, tax cuts for Made in America products. This will be the largest tax cut in history for middle-class working Americans. The president is committed to working with Congress to get this done.
So here's the latest this morning. President Trump outlining his tax priorities with GOP lawmakers as the party struggles to align on a strategy for passing the legislation. Kim Wallace of 22V Research writing, a clear framework and strategy for enacting fiscal policy this year remains elusive for the majority. We stick for now with our call that a tax package is unlikely before December. Kim joins us now for more. Kim, welcome to the programme. I want to pick up on that last line. By December, it's unlikely. From your standpoint, why is it unlikely? What's holding it up?
I think there are two related reasons, John. Good morning. The first is that margins are very narrow in Congress. Until April, it will be a one-vote margin in the House. And after that, as much as maybe a three-vote margin. We saw in December that empowered a lot of members to act as free agents to make demands and to reject demands before they were able to fund government and go home for the holidays. The second is the size of debt and the size of the bill to renew tax package. And as the spokeswoman said, add additional tax cuts to it. So you start with $4.5 trillion of an offset whole, and it grows to 5 or 6, depending on what you add to it. It's going to be an arduous process. Negotiating the substance is going to be even more difficult. It'll take time.
Kim, is that why the Senate is talking about this two-path approach, because they want that quick win? Do you think that in the end, they're going to be the ones that win?
That will depend entirely on the president's preference, I think. And yesterday was really the first time you saw the president engage in fiscal policy for this calendar year. Similar to 2017, House and Senate, mainly the House, wrote the original tax cut bill. 2017 wrote the original bill before the Senate picked it up. That's usually the course because tax policy starts in the House, and therefore that usually sets the process. Importantly, Senate rules are much more difficult, so usually you go last in the Senate to see what you can squeeze through.
Kim, a surprise was added yesterday, ending the carried interest tax break used by private equity firms. Is that real?
In two ways, no. One, in 20 years ago, when it was originally proposed, it had teeth. It bit. It raised a good bit of money. Over the years, that's been eroded by, obviously, the interests who don't agree with changing the law. And relatedly, it doesn't raise much money now in its current form. And I doubt that there are a lot of forces focused on this as a primary offset. The messaging probably not right from a Trump-based standpoint, and you just don't raise a lot of money.
Hold on a second, Kim. You said that it's not quite right from a Trump base standpoint. Which base are we talking about? Because more broadly, to tax billionaires, et cetera, is a very populist message and probably would appeal to a large swath of Donald Trump's supporters.
It's been a populist message when populism was spelled with small letters, and it remains one. It's never driven negotiations on tax policy. Taxing the rich is a great slogan. It doesn't show up in the negotiations of tax policy.
Then what do you take?
The contrary, 2013, 2015, 2017, the higher end tax earners saw their taxes reduced each of those times disproportionately.
So, Kim, what do you make then of this being thrown in? I mean, if you can understand the strategy behind negotiations, which a lot of people say are going to be very difficult, given that there has been some sort of unity among Republicans so far, but that's only to placate the different parties ahead of a very vicious fight over the budget. What's your inference about where the lines of fighting will be when it comes to the budget?
Oh, I think there are many. That's why we're in February and there's still no framework for even a budget resolution. Just to put out broad numbers and then assign savings to the various authorizing committees. That's usually not a big step for the majority, but because of tight margins and because of debt aversion, and it's growing in Washington among elected members, both parties. This process has been very difficult, chaotic, and has not yet produced unity. Not only has it not produced unity within the Republican Party of the House, there are very scant conversations between House and Senate Republicans how to move forward. That's why Senator Graham asked for a meeting with the president, hoping it would catalyze the process. The difficulty is the constraints on elected members, and there are many. And while taxing the rich is popular, when you look at the items the president's spokeswoman mentioned yesterday, most of those erode long-term health care and retirement funds for working people. And in a package that would cut taxes for people in the top half of the income brackets, it's a curious mix. I don't think the messaging holds.
But Kim, you and I both know they need offsets, which I also want to get your take on how much of that offset is going to be driven by the tariffs President Trump has been talking about.
The U.S. brings in around $90 billion a year in tariff revenue. It's in the offsetting receipts category. I've spoken to people who have modeled as much as doubling that. The whisper is that Speaker Johnson's back of the envelope, if you will, has as much as $2.8 trillion over 10 years in tariffs. Not many people think you can raise that amount of money, but the statement is that they will rely on tariffs and tariff revenue to help offset some of the spending. I think the takeaway there is not so much how much can they ultimately raise or even plan to raise, but the fact that they've admitted tariff revenue is necessary as an offset.
Well, there's going to be a lot of spending.
Likely going to have some tariffs later.
That's for sure.
Year.
Hey, Kim, appreciate your time. Thank you, sir. Kim Wallace there of 22V Research. Let's talk about that spending. The tax priorities of the Trump administration maybe colliding with the thoughts of the bond bulls out there who got excited about the words of Treasury Secretary Scott Bessent earlier this week. No taxes on tips, no tax on senior Social Security, no tax on overtime pay, renew the president's 2017 middle-class tax cuts, that's TCJA. We're all expecting that one. And then there's going to be tax cuts for made-in-America products as well, adjust the SALT cap too. That's a long list.
Long list, it's a lot of money, which to Chris Verrone's point is his number one question to Kevin Hassett is what are they looking at to potentially push back on their spending plans? Is it going to the bond market that ends up having a seat at the table and says this is just too much for the deficit?
This is reason why it's so hard for analysts to come up with any conclusions. Because on one hand, you have the sweet words of Scott Bessent basically saying that if you look at the bond market, that'll be the ultimate check on what we're trying to do. And if Trump's policies go into effect as planned, you're going to get disinflationary growth, which is the sweet manna of markets. And then on the other side, you have a lot of people saying, look, we have these priorities and we can tolerate everything that comes with it. And a little bit of pain is worth it in the long run. Which is it? And can that pain be tolerated in the bond market?
This is going to be a lot of issuance at the front end if the comments of the Treasury Secretary are anything to go by, who didn't seem too interested in adjusting the maturity profile of the Treasury debt anytime soon.
He was so nuanced in the way he answered that. He said, not anytime soon. Later this year, when some of President Trump's policies have gone into effect, if we get disinflationary growth that leads to some sort of lower yield regime, this is the implication, we can rethink about what that looks like. Essentially, this is him saying with Janet Yellen's much criticized plan, but also sort of implying that there's some line where if yields drop low enough, maybe they could term out the debt. I'm curious, what is that line?
I'm just going to guess if he said something different, if he said the opposite earlier this week in the two interviews he'd done, the 10-year wouldn't be at 442, it would be somewhere else, and that somewhere else would probably be higher.
Which is the reason why he didn't say it. And again, it shows how he is so laser-focused on not screwing around with the market right now because he wants that to become constant to create the pathway for some of the stability that Donald Trump is talking about.
We're laser focused on the jobs report. That drops in about 2 hours and 5 minutes time. A sneak peek of our survey here at Bloomberg. Lots of estimates go into this. The median at the moment is 175. The previous number is 256. Lisa and many of you very focused on the benchmark revisions. We'll catch up with Sarah House of Wells Fargo and Anna Wong of Bloomberg Intelligence, of Bloomberg Economics a little bit later this morning, so look out for those conversations. Up next on the programme, we'll catch up with Shweta Khajuria of Wolfe Research as Amazon looks to keep up with AI demand. From New York, you're watching Bloomberg TV. 2 hours away from the jobs report, 175 is the number we're looking for. The previous number, a very punchy 256. We'll see what we get at 8:30 Eastern Time. Going into it, the scores look like this. 3-day winning streak into Friday on the S&P. We're just about unchanged. On the Nasdaq 100, we're negative by 0.1%. Lots of conversation about the bond market. 2-year, 10-year, 30-year. Let's sit on 10s. 10s right now, just about unchanged, 4.43. Priya Misra, JPMorgan Asset Management, on the program a little bit later. What will generate the bigger move, Bramo? You referenced it. A weak report or a strong report?
She thinks that a weak report is the thing that's going to really cause the bigger ripple effects in markets. And it makes sense given how much we've reset away from an expectation of overheating toward searching for cracks. That has been the focus of so many people. And if we don't see cracks, well, all systems go. I will also add, nobody is taking this number that seriously on the upside because they're all talking about the fictitious upward revision that happens seasonality.
The 10-year yield is on track for its fourth consecutive weekly decline. And I had to check this multiple times, Lisa. The longest streak going back to 2021. I was quite surprised by that. It's been that long.
We've gotten upside surprises to inflation pretty steadily until maybe about 6 months ago. And then you started getting those downside disinflationary surprises, yet the market was still worried about overheating. Now maybe is the sort of catch up that we maybe should have had a couple months ago.
Guess what else is on a 4-week streak? With that in mind, the Japanese yen. Dollar yen declining for 4 consecutive weeks. That's yen strength. Dollar yen right now, 152. Just about weaker against the dollar by 0.5%, but more yen strength through the last week or so. Chris Verrone on the program a little bit earlier, as Strategas, making the point that this is, I think, capturing the flow story. This speaks to the outperformance that you're starting to see in the equity market, just the money going elsewhere.
A lot of people said that the reason why the U.S. markets had been so strong for so long was because there was such weakness over in Japan and some of these other economies that they had nowhere else to go but the U.S. If that shifts, does that flow of money shift as well? And what Chris Verrone was saying is it's directly correlated with some of the weakness you're seeing in U.S. markets.
And some of the strength we're seeing on the DAX, for instance, in Germany, 10% gains so far this year. Unreal. Dollar yen right now, 152. Let's get you some top stories. On our radar this morning, Treasury Secretary Scott Bessent expressing confidence in Doge, telling Bloomberg he personally vetted the Treasury employees on Elon Musk's team, and there's been no tinkering with the department's payment systems.
And he called it one of the greatest audits he thinks in his adult life. The issue is actually on the other side of Pennsylvania Avenue. 6 Republican senators are reaching out privately to the White House and saying they object to this. There's a lot of cause for concern that these individuals have access to the Treasury system. And then, of course, yesterday we saw a federal judge actually temporarily limit that access and only giving those workers read only because a group of unions accuse them of illegally sharing members' information. The story's not going away, and I'm sure it's providing a ton of headaches for the White House.
Scott Bessent did a very good job of just sort of smoothing over and saying, look, it's not even us. It's the Fed. Look at them. And by the way, I talked to the Fed, and I can criticize things in the past, but looking forward, I'm not going to give them guidance. Things are all normal, and they're going to operate as status quo. That was a message that was very much at odds with some of the make it, break it, and as quickly as you move.
Democrats and Republicans, both these administrations under the Treasury departments of either party will always say that it doesn't have the power to stop or prioritize these payments that are authorized by agencies. But obviously, people are looking into them, and that has been a massive cause for concern.
The complete policy platform has got lost. Been buried by the trade headlines of the last weeks, been buried by all the attention that goes to Doge. We have to keep going back to the tax platform. The tax cuts could be massive this year. They did a decent job of going through some of the priorities, but one of the standouts and the surprise, I think, for us all, was calling for an end to the carried interest tax break. Did not see that coming from the President of the United States.
Did not see that coming, because remember on the campaign trail, we called this the Oprah Winfrey election. Every day there was a new tax policy, no tax on tips, no tax on overtime pay. Donald Trump was throwing almost spaghetti at the wall when it came to taxes. He already had TCJA, and he wanted to expand it even further. So when it comes to putting out the carried interest loophole, many people are interested in this because a lot of private equity firms and leaders that backed him and are probably going to be calling the White House saying, hey, what's this about? But you brought up a great point earlier, which is the fact that for populists and those individuals in the MAGA base, this is really going to resonate, which is potentially why someone like J.D. Vance might be behind this.
So according to McKinsey, about $8.2 trillion was under management from private equity funds. If some of the carried interest, which is basically how much, the 2 and 20, it's the 20 that they earn, the 20% on some of the investments that they make, if that gets taxed at the same rate that everything else does, the estimate is that could raise $12 billion. It's a drop in the bucket, but you need a lot of drops in the bucket when it comes to the overall U.S. budget to fill these plans. If it is realistic, it shows that maybe this is going to be a very different type of budget plan than many people were expecting.
Is it about the politics or the money? And I would suggest it's about the politics. And I think you made a really good comment about 15 minutes ago. Whose base? The president's base has got a lot of people in it from a lot of different places. This is a populist message coming from a populist president.
It's a president who has many different bases, as you say. And the base that he has surrounding him seems to be the base that's probably earning some of that money from those $8.2 trillion of private equity assets. Question is, how much does he have an eye on what the message is going to look like and what those headlines are?
This is one of those policies that you see and you're like, this is going to create weird bedfellows in Washington, D.C., because this is something Senator Elizabeth Warren or Bernie Sanders would absolutely vote yay on.
If you polled Wall Street, maybe you'd get one answer. If you polled the country, I think you'd get the obvious answer. They want this gone. It makes sense. You poll the country. This is where they are right now.
Everybody has agreed. And one of the big questions is, why has it been so hard to get through?
Special interest.
Can he push through that, especially at a time where they need to raise money?
I still maintain it's not happening. And if it does, I will buy you all dinner.
And if it doesn't, it's because of special interests, as always. Let's turn to this story. President Donald Trump meeting with Japanese Prime Minister Ishida at the White House today. Officials familiar with the matter telling Bloomberg Trump met with the U.S. Steel CEO just yesterday. Could we see a change here too?
Potentially. Do you know why? Donald Trump has been, as we've been talking about, everywhere, doing everything all at once. What has he not been commenting on? This takeover, this U.S. Steel takeover. Potentially there is a way he can sell this to the American people. I might allow this deal. I spoke to the CEO. The company needs this money, but I still will protect U.S. aluminum. And at the same time, in steel, maybe he'll put up tariffs alongside of it.
I love imagining these meetings between the prime minister that come there. Here, I have this. Take this thing of roses, take this thing of chocolates. OK, here's the deal that we're going to make. And they discuss it. Is this sort of the goal, too, to be able to have deliverables? We get this, they get this, we made a deal, it's all beautiful, we can move on.
He's very transactional. So, yes, if there's a potential deal to be made, I could see it happening.
Let's turn to tech. The latest earnings from Amazon delivering better than expected earnings, but giving disappointing guidance for the current quarter. The CEO, Andy Jassy, warning growth will be lumpy due to hardware delays and power constraints. Shweta Khajuria of Wolfe Research rating the stock outperform with a 270 price target. Shweta joins us now for more. Welcome to the programme. First question, what we just heard from Amazon, how much of that was in line with what we'd heard from other players, the likes of Microsoft, for instance?
Well, thanks for having me. I would say the parts that were similar from at Amazon from Andy Jassy to Microsoft and Google and Meta was around CapEx and cloud. So what we heard from Andy Jassy were two things. One is that these CapEx investments, where they guided to over $100 billion in CapEx for 2025, they are leaning into what they believe there is demand for. And they would not be spending this money if they did not know that there was demand coming, because you procure all these infrastructure and data centers only if there's demand. And we have heard that time and time again from Google Cloud, from Sundar, as well as at Microsoft. That was part one. Two was his comment around and his reaction to what happened with DeepSeek and their R1 model. And the commonality here is basically the same thing that we heard from Zuckerberg at Meta, as well as Sundar at Google, around if costs of training and inference go down, the intuition is that the demand for AI will likely expand. It will expand the TAM because there will be so many more uses that will be attractive around applications to drive AI compute. And against that, all these companies are leaning into CapEx spend.
Shweta, so many analysts after these earnings came out pointed out time and again, this is still a behemoth. They're going to do very well. Mm-hmm. We don't understand why people are punishing them. And yet 4 out of 6 of the magnificent 7 that have reported so far have been meted with a really disappointing response in markets. How much do you think that ultimately this is investors saying we are worried about valuations and we're not going to extend things further, period, even though there is still that same promise of cloud computing?
I think it is more of that. I mean, if we look at valuations now, all the AI-levered names have done so well over the past 2 years, where very limited upside for multiples in Meta or in Google, given that they also have the search overhang, or even Amazon. Of the mega cap names that we cover, I think that Amazon has the best valuation on a growth-adjusted basis, but it is more of that against the fundamentals. I think that there's a common belief that AI demand and AI is going nowhere, but given where the multiples are, perhaps we would have to see greater upward revisions on earnings before they get more credit on the share price.
Just to sort of underscore this point, Shweta, do you think that this is more an issue of just simply people jittery about valuations and maybe even the flow of money due to other considerations, and less about DeepSeek and a feeling that you really can do it with less?
I think so. I think that the knee-jerk reaction with DeepSeek and R1 model was that this is negative for the mega cap names, at least within internet. I'm going to refrain myself from talking about the impact on NVIDIA, but for the mega caps within our coverage. But as more commentary came out from all the CEOs, it is becoming increasingly clear that perhaps there is demand that is more to come. And all these companies are looking at R1 model under a microscope and will figure out a way to lower costs. So I think that is established that costs will likely come down for training and for inference, and against that there will be demand. I guess the question is, we now need to see accelerated path to returns on these investments, and until we see that, estimates likely won't go up, and until then they may not get full credit.
Shweta, appreciate it. Good to catch up with you. Shweta Khajuria there.
Thanks to
of
have
Wolfe
me.
Research. Thank you. Amazon is down by 3%, constrained by capacity. Not a bad problem to have. Bad problem to have is when you've got too much capacity and not enough demand, and that's not where they are.
And yet it hasn't worked, because pretty much all of the main cloud computing service providers, all the main hyperscalers have said the same thing. The only reason why we didn't blow it out of the water was because of constraints. Still, Andy Jassy tried to do the good messaging. He said, we think virtually every application that we know of today is going to be reinvented with AI inside of it, really doubling down on the promise of this. Not enough.
It's a show-me market for some of these names, that's for sure. Amazon is down by a little more than 3%. Broader equities just about unchanged on the S&P. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. The Israel Defense Force says its Air Force conducted a strike in Lebanese territory on 2 military sites. The IDF says the sites contain Hezbollah weapons, which is a violation of the ceasefire agreement. Meanwhile, Dallas Fed President Lori Logan has suggested that interest rates may already be near a neutral level, eliminating the need for further rate cuts even if inflation continues to cool, though she added the Fed would likely need to lower rates if the labor market deteriorated. And take a look at Porsche shares that are down in German trading. The luxury automaker says profits will slump this year. Costs are mounting after executives misjudged how eager sports car drivers would be to turn electric. Turns out they're not so eager, so Porsche is saying it will take a hit of as much as $830 million as it adds more combustion engine and hybrid models. That's your Bloomberg Brief. John?
Yahara, thank you. It's the sound of the engine.
I was just going to say
the engineering. You can't replicate that.
I mean,
right?
Honestly, do they really not understand their clientele? Do they really not understand
Seriously?
the people who want to drive up and be seen? I mean, they don't want to sort of seamlessly come in their Porsche. Come on.
Well said. Speak to Matt Miller next time.
Thank you.
Equity futures on the S&P, just about unchanged. Up next on the programme, we're counting you down to payrolls.
If you asked any economist what the hardest month to forecast payrolls is, they would say January. We're going to see a little bit of this, pre-election uncertainty unwind. The actual Trump uncertainty, I think, will actually weigh on how much some of these gains can have going forward.
Up next on the programme, we'll catch up with Sarah House of Wells Fargo, and we'll speak to Anna Wong of Bloomberg Economics. Live from New York, this is Bloomberg. Treading water. How many times do we do this going into a payrolls report? Drops at 8:30, equities going nowhere. Euro dollar going nowhere. The bond market going nowhere. The 10-year Lisa 443.
I feel like, though, even though we've done a lot this week and we've worried about 15 different narratives, I kind of feel like it's been running in place, because are we really leaving this week with any more clarity or a feeling of direction? I'm just wondering on a broader level in life, but I also wonder about markets.
You're getting philosophical. Is this a therapy session again?
It just feels exhausting without conclusive evidence that we are nearing some sort of measure of progress.
Which is why it's exhausting.
Yes, exactly.
Precisely why. The jobs report drops at 8:30 Eastern Time. Under surveillance this morning, we're counting you down to payrolls.
If you asked any economist what the hardest month to forecast payrolls is, they would say January. The last few Januaries, we've seen this very low layoff environment. And the low layoffs have really helped boost that January payrolls number. The past two payrolls, and including this one, I guess, we're going to see a little bit of this pre-election uncertainty unwind. The actual Trump uncertainty, I think, will actually weigh on how much some of these gains can have going forward.
So here's the latest this morning. Investors eyeing the payrolls report out in just under 2 hours' time. Economists expecting strong job growth and flat unemployment. Bloomberg's Anna Wong joins us now for more. Anna, welcome to the show. It's good to see you. Let's just get to why January is so difficult to forecast. What's special about the first month of the year?
Well, there's first thing, there's weather. And in the last couple Januaries, it's been unseasonably warm. And as a result, I still have the PTSD from the last two Januaries when we saw a gangbuster month of job prints. That's for one thing. And the second thing is a seasonal factor. So this year it's particularly difficult because we are expecting large downward revisions to jobs number throughout 2024. The benchmark revisions will likely reduce the non-seasonally adjusted employment level of March 2024 by about 700,000. And further out, there would also be about 200,000 downward revisions to the birth and death model. So all this will be changing how BLS estimate the seasonal factor. So I think the biggest component is the seasonal factors, which could, subtract or add about 50,000 from the consensus.
Which is the reason why Jonathan Pingle called this a random number generator yesterday, for a variety of reasons, but in part because of some of these trends that you're talking about. I want to talk about the revisions and how much that could shift the narrative for 2024, where a lot of people were worried about an overheating of the economy. How much do you think that we are going to reframe our knowledge of the 2024 jobs market after the revision that you're expecting of about a downward revision of about 700,000 jobs?
Right. So first of all, once you take into the seasonal adjustment, because the downward revisions happen to the non-seasonally adjusted numbers, once you factor in seasonal adjustment, I expect that it would show very close to negative or actual negative prints in September 2024 and October 2024. And it will be a very small, minor negative print. So in that sense, maybe it will. I don't think still that's enough to change the complete narrative that you did see a improvement in the labor market maybe in the last couple months of 2024. There is some forward-looking implications, though, which is that if the BLS should downward revise the birth and death factor model, it means that in 2025, this year, for each payrolls, we're going to be seeing significantly less support from this artifact of the birth and death model. Because last year, the birth and death model contributed to 1.2 million jobs added out of 2 million jobs actually added. So a downward revision to that model has very significant forward-looking implications for future forecasts.
Anna, appreciate your input. Thank you. Anna Wong there of Bloomberg Economics. Lisa mentioned Jonathan Pingle of Natixis calling it the random number generator. I think we did that for him. Sonia Meskin of UBS came out and called it an exercise in predicting noise, right?
Because of the upward revisions, you are correct. You were the one that said basically that's the implication here. And so today that's what we're doing.
Don't want Jonathan getting a call from his boss, Why'd you call it that? It's important. 8:30 Eastern
Different
time.
Jonathan called it that.
Moves markets. Sarah House of Wells Fargo joins us now for more. Good save. Sarah, welcome to the programme. The benchmark revisions, we just talked about them with our colleague Anna Wong. How big are you expecting those revisions to be?
Yeah, so we're looking for them to be in the ballpark of what the preliminary estimates show, which were around a negative 800,000 downward revision. But you have to remember these are applied to the period before March 2024. So the benchmark revisions are already close to a year in the rearview mirror. I think Anna was right in emphasizing what are some of the seasonal factors going to do, what's happening with the birth-death model in terms of what those downward revisions imply. So remember, the birth-death model is essentially the error that we see in terms of the survey, and so I think that does point to slower momentum that we had in the second half of 2024. But I think it will be interesting to see what's that more recent momentum the past few months. Do you see things picking up and still picking up in the fourth quarter after we get through these revisions?
Sarah, you noted that those revisions probably won't be enough to change the overall picture of solid hiring. Do you think that there is a higher bar right now for the number that we get from non-farm payrolls? The random number generator, as Jonathan Ferro said yesterday. Or do you think that just to basically show that we are seeing upside, that it's not going to wreck markets in any kind of capacity, but if we see downside, that could be really concerning?
Yeah, I think the general narrative has been that the U.S. economy and the labor market in particular has been much more resilient than I think most people anticipated. And so in some ways, I think an upside surprise would be less of a new development than if you were to see conditions weaken more than expected. So I do think the risks are somewhat asymmetric around what this print could be.
The Fed's Austin Goolsbee yesterday said you could overheat and you could deteriorate, but if you could freeze the job market just exactly where it is, that's not a bad spot to me. It looks like something approaching full employment. Do you agree?
Yeah, I think overall, when you look at the levels of the unemployment rate, the overall pace of hiring, we're still seeing them at a pretty healthy level. So yes, we've decelerated over the past year. It looks like last year even wasn't quite as strong as what's currently being reported. But with unemployment at 4.1%, that's smack dab in the Fed's central tendency for where they think this jobs market should be to eventually get consistent with their 2% inflation target. And so I think when we're looking at the absolute state of things, we're still doing okay, but there's still, I think, some concern as we head into 2025 with some of the policy uncertainty. I think some of the slide in demand that we've seen over the past 2.5 years, kind of where do things settle out? Do we stay where we are right now, or is there a further softening to go?
If there is further softening to go, what policy uncertainty are you most hoping to get more details about? Is it tariffs? Is it immigration?
So for the jobs market, I think the immigration story is going to be even more important this year. And we're actually looking for the unemployment rate to hold roughly where it is, even as we're assuming you get some step up in tariffs, which would dent demand, dent growth, and therefore hiring. But given that we're likely to see supply growth get much more constrained. Now, the numbers we get today might not show that. It might look like the labor force is up a lot from last year due to those population controls. But overall, we're looking at much weaker inflows in terms of immigration, potential deportations. And so I think that more constrained supply aspect is going to be a really important story here in 2025, but also help keep that jobs market roughly balanced, even as you do have a somewhat softer demand picture than what we've been dealing with over the past year or so.
Sarah, thank you. Sarah House from Wells Fargo. Wells Fargo looking for about 200K on the jobs report a little bit later. The range is as low as 105 to as high as 240. We talked about Jonathan Pingle over at Natixis, the most accurate forecaster for payrolls in our survey, the most accurate forecaster for last year. He's looking for that 240.
All I can say is the more we focus on revisions in the birth-death model and random numbers, the more people will ignore and move on. And that maybe is exactly what many people in this market want.
At 8:30 Eastern Time, is that our promo?
Well, I just don't know. If it's a downside surprise that could potentially shake the markets, it could be 450 and people will just say, yeah, it's a random number.
You really want this weekend, don't you? Hey? Up next on the programme, Priya Misra of JPMorgan, Terry Haines of Pangaea Policy, Alan Zentner of Morgan Stanley, James Foley of Rabobank. The second hour of Bloomberg Surveillance is up next. Lisa might go home. I've got no idea. She might stay. The jobs report, a few hours away.
Am I wrong?
I think the most important is the labor market.
I think some of the data has been overstating the health of the job market.
We're going to see more challenges to labor supply.
We would expect the unemployment rate to go up if the tariffs against, Canada, Mexico, China are in fact sustained.
Going forward, I do think that you'll see a payroll impact estimate from slowing immigration, but it'll be kind of harder to figure out how that happens to actual unemployment.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Do you remember the trade war? That was Monday. It's this week. Feels like months and months ago. What a week it's been. We're 90 minutes away from the payrolls report. It's just around the corner. The focus shifting to the economic data in America. The estimate in our survey, at the moment, the estimate's 175. The high is 240. The low is 105. So far, looking at the data this week, a bit of heat coming out of the American story. The economy just a little bit softer than maybe some expected. I say a little bit because jobless claims are still in the low 200s. Job openings are still somewhat elevated. The ISM's still pretty decent in expansionary territory. But this is not the fear that some carried into 2025 about an economy getting away from us and a Federal Reserve that might need to hike.
That ship seems to have sailed. A lot of the pro-growth policies that we have yet to see so far have kind of moved to the back foot, and people are focused more on the idea of maybe slower growth from a lack of certainty and potential tariffs, which is the reason why the best interview of the morning is coming up with someone who says that a weaker report will have a bigger impact than a stronger report, and that really sets up the framing of today's labor market report.
It's nice to see you get back to shifting towards promoting programming again, and what an important morning this morning is. The most important jobs report since the last one until the next one. You know how this works.
Crushing it.
Right? In the bond market, big week for Bramo. That's why she's so tired. The 10-year yield at the moment, 443. The Treasury Secretary coming out and saying they're very focused on 10-year yields. And then the following day, we hear a tax plan that includes a long, long list of tax cuts and very few offsets, even though we got a surprise.
We got a surprise when it came to carried interest loophole. Trump apparently wants to close that now. People I'm talking to say, please don't read too much into this. They do not think it's happening. I think what's more interesting last night is I would say I started the week, especially when I caught up with Jason Smith, chairman of Ways and Means. I started the week thinking the House was going to get railroaded this weekend by the Senate. Trump went into the evening with some of these Congress members, and today, potentially, we will get their bill coming out, or theories of what this bill is going to be, what's going to be in it, coming out today. And maybe he wants to go back to this one big, beautiful bill, which means a lot of tax cuts, which means a big deficit.
The takeaway for me is this is going to be messy. This is messier than a whole bunch of executive orders that talk about tariffs. And that messiness is what a lot of people in markets are putting into their models of maybe that pro-growth impetus isn't necessarily going to come as quickly as many people thought.
So we started this week talking about trade, and we close out this week talking about tax cuts. And what I really want to know is how one complements the other. And hopefully when we catch up with Kevin Hassett, the National Economic Council Director, later on this morning at around 9 a.m., we can get some answers to that question. Because around the objectives around the trade war, and I think we've got to go back to Monday, what are the ultimate objectives here? Is it a drug war and not a trade war? Is it about getting concessions on the southern border? We've had one already. Is it about reciprocity? I'm thinking about China, I'm thinking about Europe. Is it about deficits, or is it about paying for these tax cuts? There's a lot of questions there.
I think when it comes to Donald Trump and the fact that he is transactional, when he looks at tariffs, it's a bit of everything. Kevin Hassett himself called it a drug war when it comes to Canada and Mexico. But potentially, with all of these tariffs, they continuously talk about these could be incredible revenue raisers and to offset. Potentially, that means you're going to have to get the tariffs first to then offset the tax cuts and the longer list of tax cuts we got last night.
The jobs report, 8:30 Eastern Time, 1 hour and 26 minutes away. Equity futures at the moment, totally unchanged. This market's going nowhere. Coming up on this program, Priya Misra of JPMorgan on the Fed's balancing gag, Terry Haines of Pangaea Policy as Republicans look to strike a deal on Trump's agenda. And we'll catch up with Zentner of Morgan Stanley later on this hour with payrolls on deck. We begin this hour with stocks steady ahead of payrolls data due at 8:30 Eastern. Priya Misra of JPMorgan Asset Management writing this: valuations imply that the rate reaction into payrolls is asymmetric. A weaker payrolls report will have a bigger impact than a stronger report. Priya joins us now for more. Priya, it's good to see you.
Likewise.
Why is that the case when yields have already drifted lower by some 40 basis points in the last few weeks?
So I think You're right. Rates have fallen. I think if you look at why we got to that 4.8% on the 10-year, it was actually driven by this fear that the Fed might have made a policy mistake. Maybe we were re-accelerating. I think that's been taken off. Inflation does seem to be, look at 3-month moving average of core PCE. It's 2.3, very close to that Fed target. So I think the Fed message has been, we've recalibrated. The first 100 basis points is done. And after this, we're going to just have to, wait for more certainty. I think the other part is the market got a little ahead of itself in terms of fiscal. It was always going to be about sequencing. We got trade. And I think trade is creating all this policy uncertainty. Fiscal is going to be messy. I like your word on it. We're going to spend all year talking about fiscal because there's just so much and there's so many stakeholders. So I think some of that move from 4 to 4.8 was that. The reason I think is there's an underlying fundamental assumption of US exceptionalism, the fact that the soft landing is solid, that the economy is strong. You start to see, and it's all the underpinning is the jobs market. If that starts to crack, and we've seen, it's a narrow job growth. If you see, and we're looking for the soft landing to continue, but what I do watch for is and today is going to be also messy because we're going to get the benchmark revisions, we're going to look at wages. Let's look at the totality of data. Hiring has been slowing, but if it is slowing to a sort of worrying level, that's when I think those rates are going to start to price. And we're pricing in 1.5 cuts this year from the Fed, which in an on hold, you should always price in some chance of a further cut because the Fed thinks that policy is restrictive. So the Fed's telling you their reaction's asymmetric. I think 4.4, 4.5 is not that high on the 10-year. So that's why I think if you get a weak report, which we're not looking for, but if you get 100,000, and actually we don't even know what is weak because of labor supply, 100,000 used to be normal. I would argue 100,000 is weak now. If you get something like that, I think the market's going to price in more cuts, and we're going to start to question how strong is the U.S. economy.
That's exactly where I wanted to go, to pull out Ferro's random number generator and say, okay, what could cracks look like in this number, and how big could the response be? Would we get, say, a huge rally into the long end of the yield curve, but not a commensurate risk-on type rally in stocks and even credit?
I think it depends on where that weakness is coming from. If it's coming from a broad-based deceleration in labor market, I mean, it is just one report, so you may not get such a big reaction in any market. But I think if we have policy uncertainty, particularly on trade, that's negative for growth. And if you start to see that maybe it's a weakening of the labor market, so I think we look at the sectors, where is the weakness coming from? Are we seeing I would say layoffs are still low. So you may not get a very big reaction today. We're going to be watching, but I do think that the curve is likely to flatten. And the reason for that is we don't know what the Fed strike price is, meaning, at what point does the Fed start talking about rate cuts? They're not going to respond to one number. So I think it's the 5-year and out part of the Treasury curve that's going to say, well, if the economy is not that strong, we're getting this policy shock or set of shocks. Well, then maybe the Fed can't hike that much, but they're going to stay on hold. They're going to need more data. So I think risk assets might struggle a little bit with a weak number because I don't think the Fed comes out and says, oh, let's start to cut rates. They're going to say, let's take a step back. We're still above target on inflation. So I think a weak number today is actually weak for risk assets and good for treasuries. We've seen that stock bond correlation. It's come back. I think as inflation fears have receded, I think rates will do, or treasuries will do well. Everything else might struggle on a weak report.
I want to pick up on that in just a minute. I do want to talk about the totality of data and the revisions and how you look at something that could potentially take heat out of the story of 2024, but doesn't tell us that much necessarily about 2025. How does that factor into your equation?
I think it's important to have that fundamental view of the economy. So to that extent, we will be looking at that totality of data. But the market's forward-looking, the market's pricing in. Now we're talking tax. And I know you all have talked about sequencing. I think it's fascinating that in the sequencing of tax, what we got earlier this week was talk about the 10-year, which I think is great because, we've argued, and I think I've said this before, there's a political constraint in terms of how much they can get done on policy. I know you all have talked about it. There's a market constraint. What we got from the president, from the Treasury Secretary yesterday, they acknowledged that market constraint. So I think as we go into the tax discussion, different from 2017, where it was all about how do we get tax cuts, this is going to pay for itself. We're not hearing that now. We're hearing, well, let's look at the 10-year, which is not something the Fed can really influence. We just saw it over the last 6 months. They cut 100 basis points, the 10-year went up 100 basis points. So fortunately, it's less about Fed and Fed independence. And I think it's telling us they're going to need offsets because they're worried that the 10-year does impact the economy, which, the economy is interest sensitive. We've debated this because the economy has been remarkably resilient. There were a lot of positives. There was a lot of fiscal, etc. I think that's important, that sequencing.
Well, this goes to what Chris Verrone was saying. What is the pain threshold in the market for their policies? What do you think it is? What's your guiding light?
I would say 5%. If you ask me for a number, gun to head, 5%. The speed matters, though. And so, there's nothing magical about 5%. I would look at 5%. I would look at real rates. I think real rates matter a lot more than nominal. This has been a real rate-driven move. That 4.8, we were starting to see risk assets starting to pay attention. So anything above 4.5 to 5, if it's driven by real rates, if it's driven by expectations of fiscal expansion, deficit financed, I think then it's tricky because I think this idea that tariffs will pay for trade, if tariffs are a negotiating tool, or that tariffs will pay for fiscal, if it's a negotiating tool, you can't have it both ways. You can't delay tariffs and then expect it to pay for it. So I think people will see that. And so I would say, a quick rise in rates, getting to that 475.5, I think it's a problem for the economy and risk assets.
It's true. The rhetoric when he talks about tariffs is used for both. And I think it sometimes depends on the country he's aiming at.
Right.
But putting this together with the jobs report today, can policy coming out of Washington disrupt the soft landing you're looking for?
I have to think that policy uncertainty matters. I mean, maybe it doesn't matter for the consumer. I have a job, my real incomes are growing, I continue to spend. Companies, as they think about spending, CapEx, hiring plans, I think if you don't know which certain sectors, I think we're going to see more dispersion. Absolutely. Higher cost of capital, higher policy uncertainty. There's going to be dispersion in terms of winners and losers, which is why I think important to be diversified, important to do your credit work. But what I'm watching is what are companies saying in terms of CapEx and hiring plans? Is deregulation going to offset the trade uncertainty? We'll see. We just don't know. And so I have to think all this uncertainty has to be a growth headwind if it lasts for a long time.
Priya, it's good to see you. Priya Misra there of JPMorgan Asset Management. Lisa, just speaking to that, Bank of America put this out earlier this week. Our corporate sentiment indicator is still tracking at a record high. Mentions of better or stronger versus worse or weaker jumped to the highest levels since the fourth quarter of 2021. That gives you an idea of how rock solid corporate sentiment was coming into 2025. And what we discussed earlier this week, don't squander that. Don't squander that. We want to see that translate into actual action, hiring, CapEx throughout the year and beyond. If there's uncertainty about the course for policy, these companies are going to hold back.
And right now, they still are in that sweet spot where if you resolve that in short order, they can potentially go back to that excitement. But we already heard that in some of the earnings calls. Ford, GM, even Amazon ratcheting back some of their expectations for earnings as a result. And frankly, what they plan to do, you don't want that to translate into the raw data.
You know what? I was surprised. Front page of the FT today, deal making has suffered its worst January, worst start of the year in a decade. Remember when everyone was saying it can't get worse than the Biden administration? M&A is going to be on fire. Actually, it fell nearly 30% this January as opposed to since 2015, one of the worst in the decade.
I'd say give it a chance. The market's wide open. Financial conditions are still accommodative. If you want to make a deal happen, and antitrust you think is in your favour, I'd say just wait. It is still only February 7th right now and only the third week of this administration.
If we're exhausted trying to keep track of it, imagine a corporate executive trying to
They've
come
got
up
these
with
deals
plans.
ready to go.
Great. Why would they go now?
Exactly.
Why would they decide to go at a time where it's unclear what kind of tariff situation they've got to price in and what kind of international risk they might be incurring?
Absolutely. The uncertainty, as Priya was talking about, the uncertainty might mean a cost. And not only that, maybe the tax codes are going to change. Do you potentially want to wait for some kind of deal to get a better deal if the tax code changes? That might be a 2026 story.
Equity futures right now just about unchanged. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Japanese Prime Minister Shigeru Ishiba will meet President Trump today in Washington. As he left Tokyo, Ishiba told reporters he wants to build a relationship of trust and confirm cooperation over economic and security issues. During the campaign, Trump told Bloomberg he had concerns about Japan's trade surplus with the U.S. and yen weakness. And Pinterest shares are soaring in the pre-market. 19% after it posted strong revenue and gave an upbeat sales forecast. The results signaled its advertising business continues to grow despite increased competition in the social networking space by giants like Meta. And the Buffalo Bills' playoff hopes may have ended prematurely, but they can officially claim to have the league's best player. Bills quarterback Josh Allen won league MVP, beating out Baltimore's Lamar Jackson in one of the closest races in recent years. It's Allen's first time receiving the award. That's your Bloomberg Brief. John?
Yeah, Hara, thank you. I'm sure they'd all swap that to play a game on Sunday night, that's for sure. Up next on the programme, the President's fiscal priorities.
The best thing we can do for predictability is make the Tax Cuts and Jobs Act permanent. That would be the single best thing we could do for predictability.
That conversation coming up next. We'll catch up with Terry Haines of Pangaea. The jobs report just around the corner. I'll repeat the number for you if you are just tuning in. The median estimate in our survey is 175. The number drops at 8:30, so 1 hour and about 12 minutes time. Equities going into it totally unchanged on the S&P 500. No drama so far this Friday morning. In the bond market, yields unchanged as well. The 10-year short of 450, very close to 440, 443.83. Under surveillance this morning, the President's fiscal priorities.
The best thing we can do for predictability is make the Tax Cuts and Jobs Act permanent. That would be the single best thing we could do for predictability. We can go back to the 100% expensing and add some new features that I think business is going to be very happy with. But again, the most important thing is that it filters down to working wages. The real priority is fixing this affordability crisis for the American people.
So here's the latest this morning. The Treasury Secretary Scott Bessent making the case for passing President Trump's tax bill and making the 2017 tax cuts permanent. Terry Haines of Pangaea writing, should the tax bill go to plan, it likely convinces markets to fuel US economic exceptionalism for longer and with more fervour. Terry joins us now for more. Terry, welcome to the programme, buddy. It's good to see you, as always. We caught up with Kim Wallace of 22V Research, about an hour ago, actually, who made the case that he'd be surprised to see a tax bill pass before December, and this might become a 2026 story. Are you on the same timeline?
No, not at all, John. And good morning to everybody. Not at all, because what they've got to do is they've got to pass this thing in the first calendar year. They know that. I've got the tax bill at 80% likely to happen. The reason why is you've got a Congress that knows it needs a signature accomplishment, and you've got a president that wants things. Look, what you'll hear from Washington tax boffins now is all process related and kind of third level stuff. But Bessent will give you the clue here. What they want to do is preserve United States economic exceptionalism in the markets, absolutely, for as long as possible. They need a tax bill for geopolitics to keep America strong. They need a strong economic policy to buoy the domestic economy and to make America strong abroad. All that stuff. And by the way, they've got to get rid of a world where debt service is the biggest expenditure. So because that imperils all of the stuff that I just mentioned. You've got a president that's interested in doing big things. This is a time for big things. This isn't a time for small ball.
So is this a time for one big bill or two? I'm sorry, this is the minutia of Washington, but I think it does matter because this is going to be incredibly hard, one or two bills, to make sure that this Republican Congress signs off on it, given, Terry, how slim their majority is.
Well, it matters some, Annmarie, sure. I'm not going to say to you the process doesn't matter at all. Of course, it matters some. What I am suggesting, though, is that you shouldn't be diverted. No one should be diverted by process as if it's the main thing. And one bill, two bill, they get this thing done. You might recall back in 2017, the Congress faffed around with doing health care for the first 4 months of the year, and then only switched relatively late into the tax bill. That's not going to happen this year. They're all about economy. But what I would suggest is that the answer to the process question is anything that helps achieve those big goals that I just mentioned is what the process is going to to end up being. Beyond that, though, it's minimal. The people that are in favor of one big bill, by and large, are people who are afraid to cross Trump. But if what ends up happening is that two bills provide a quicker start to all this, then he's going to be for that too, and he said so.
Terry, the president has talked about a lot of policies, tax policies he would like to see. Yesterday, we got carried interest loophole added to the list, which took everyone by surprise. You and I both know that for decades, Washington has been trying to close this loophole, and they failed. Why is all of a sudden this a Trump policy?
Well, I thought you all summarized this very well in the last hour. It's by and large political. It's certainly not a revenue raiser. I mean, there's one source that I've seen recently that estimated it raising something like $12 billion over 10 years. So it's a rounding error in the bigger picture. But you're absolutely right that it puts him on a kind of a populist political path. And if it doesn't happen in the end, well, it doesn't happen in the end. But that's not a frontline issue here.
In the meantime, we got the review from the Committee for a Responsible Federal Budget for the potential bill. It isn't great. It isn't great for that wonderful 10-year yield that Scott Bessent looks at. They said that it would boost interest costs by about $1.3 trillion over the next decade, exceeding $250 billion per year by 2035. Terry, how feasible is it that this Congress has the capacity to pass this bill and not just totally upend the bond market?
Well, here's a perfect example of what I mean by process, Lisa. Everybody's kind of focusing on the existing rules, assuming this is exactly like 2017. It's not at all like 2017, in part for the reason you mentioned. There's a much less tolerance for extending debt and deficit than there was in 2017, and you had a relatively weak president and a relatively strong institutionalized Senate back in 2017. The biggest debate that's happening right now isn't popping up in Washington conversations to markets very much at all, which is whether you'll use current policy as the baseline or current law as the baseline. Use current law as the baseline, then you're into what Maya McGinney's group talks about there. But if you change into current policy, then you become much freer to actually make the tax cuts a whole lot bigger and actually free up a lot more on what your pay-fors are and your spending are. I think I know which way this is going, and it's not going back with the small ball the way it used to be. It's going to the new baseline.
Which, Terry, raises the question of whether will it be allowed by this Congress. And some people point to the fact that you've actually seen quite a bit of unity when it comes to confirming some of the nominees, a surprising degree to some people. Do you think that is just playing nice ahead of the hardball that's expected around the budget, or do you think this is setting a precedent for what's to come, that there will be that unity?
I think there's still going to be a good deal of unity, and I think the Senate particularly has done a very good job of defending itself against Trump demands. You'll remember back in November, Trump was blustering on about how he wanted his nominees confirmed immediately, and well, guess what? We're still confirming nominees. That a lot of this stuff is being done fairly quietly, but at root, people that are talking about maintaining the current institutional rules around the tax bill in particular are essentially saying that the Senate parliamentarian is going to be more powerful than the President of the United States and a majority of senators and the will of lots and lots of the American people and probably markets. So I think I got, unfortunately for the Senate parliamentarian, I think I'm taking the other side.
Terry, appreciate it. Well framed. Terry Haines there of Pangaea Policy. Did we settle that debate, 25 versus 26?
Well, Terry thinks it has to be done this year. He thinks it's going to happen this year. They have to have a win, and they know that next year is going to be very challenging. You have midterms then coming up. It has to be this year, which is why I think potentially you can maybe get one bill.
There also is this concern about the market. If you don't get some of the pro-growth measures, then how do you offset some of the other things that are coming down the pike?
Have to define the market, not your market. Bond market might be happy with that.
The bond market,
right?
Well, yeah, but happy. The rest of the world, yeah.
Sort of like
exactly
that kind of miserable happiness that the bond market has.
I just got another notice about an asteroid.
Describing Lisa?
No. Ellen Zentner of Morgan Stanley up next. That's brutal.
I know.
The jobs report is 60 minutes away. The median estimate in our survey is 175. Going into it, equity futures are totally unchanged on the S&P 500. Unch and going nowhere. Likewise on the Nasdaq, likewise on the Russell. Let's get you some movers, your morning movers, with Yahira Hackers. Hey, Yahira.
Hi, John. I have 3 names for you moving here in the pre-market. We start with Skechers. Those shares are down some 12%, and that stock is taking a hit after earnings fell short of analyst estimates. And that was for 2 reasons. First, FX was a big headwind for the company. And on top of that, it's continuing to see weakness in China. So because of this and potentially tariffs, Skechers gave a cautious forecast that investors were not satisfied with. Next up, we have Expedia. It's a different story there. Shares are popping some 10%, and that's on the back of strong bookings over the holiday season, and it gave investors something they love, a quarterly dividend of 40 cents per share starting in March 2025. And due to all of that, you're seeing a number of price target raises over at JPMorgan and Barclays, and even an upgrade by HSBC. And last up, we have another riser for you, and that is Pinterest. It's soaring 20%, and that is because AI is actually paying off over there. Apparently, their AI tools are actually more lucrative for businesses because they're better able to target people, and that contributed to a record quarter. For the first time, its revenue came in at above $1 billion. And yes, John, you can see my Pinterest board after the show.
Stock is up by 20%. I'll take a look. I've got one too.
He does.
I do.
For what?
A renovation that I didn't do, but it still exists. You want me to share it with you?
Yeah, I would love to. I'm sure it is. It's just, Pinterest. I don't have a Pinterest
I was
page.
surprised by my experience on Pinterest, but
Really?
I'll share that another time. Yeah.
I mean, the positive experience.
Sure, lots of things going on there that I didn't realise.
I had a Pinterest board.
What's going on in Pinterest?
Anyway, on our radar this morning, Amazon delivering a disappointing outlook. CEO Andy Jassy warning growth could be lumpy and hinting the company could face capacity issues in its cloud computing division, echoing the concerns we heard from Microsoft earlier this week. That stock here, Lisa, down by about 3%.
So this goes to the idea that if this holds, we'll have 4 of the 6 Magnificent 7 stocks down after reporting earnings at a time where they all can't keep up with demand, which is a great problem to have. Is this the beginning of a shift where investors no longer tolerate massive expenditures because ultimately valuations are too high, even if you have wonderful words that accompany it and promises of incredible things in the future? Hard to say this is a deep seek moment and more an excuse to sell at very high valuations.
All this warning on AWS growth constraints, you sort of forget that they had a great holiday quarter. And I find that very interesting because they've been dealing with the likes of Shein and Temu. And the reason why I'm focused on that is because I actually wonder if they're going to be able to squeeze those Chinese e-commerce companies even more because of Trump's exemption on de minimis. Basically, that tariff, meaning those packages under $800, they're going to be the ones that are going to have one of the biggest issues with this new tariff policy.
Could get more expensive, that's for sure. Putting it all together, it's not been a blowout quarter for the tech names relative to expectations, has it? Some really mixed results across these big names.
It's been remarkably soft in terms of the takeaway. One thing that I thought was really interesting about Amazon, they mentioned the currency drag. And this is something that we've talked about, the idea of a strong dollar really impeding some of their abilities to meet expectations. They would have been at the top end of their guidance if they hadn't taken a $700 million hit because of the strong dollar. Watch this space, because you're going to hear this more from companies as they try to navigate the international space.
Particularly if you've got exposure to Japan.
Correct.
Because that story's changed a lot in the last month too.
Well, and this to me goes to the story of just little tweaks in the global picture can make a big difference to companies at a time when they're really kind of climbing to the sky and people are losing patience.
It can change a lot. To your point, some of the biggest volatility we've seen over the last few weeks in foreign exchange, particularly on Monday. That was wild. Let's turn to another story. A judge temporarily delaying the deadline for federal workers to decide whether to accept an offer to leave their positions with pay through September. The judge blocking the Trump administration from implementing the offer until he holds another conference on February 10th.
So the deadline went. It was yesterday. Basically, the judge wants to look at more the legality of this deferred resignation program. What I will say is that more than 50,000 federal workers signed up for it. That's 2% of the workforce that already signed up for it. Now they're extending it. Potentially, we will see even more sign up for this. Very interesting, though. This, I think, will go back and forth in the courts.
And this is just the beginning of this push from Doge, isn't it? You get the real feeling that they believe that this could be a big offset for the tax cuts that they're set to deliver. But a lot of people would question, how easy that might be.
I walked away from Scott Bessent's interview yesterday a bit more confused about the process of DOGE and exactly how it would go through with some of these cuts. It is being attributed as some sort of accounting apparatus that's going in and trying to figure out where to get efficiency. Who's going to be able to implement that? And they're going to be working that out through the court system.
Final story here. The Kansas City Chiefs, Philadelphia Eagles gearing up for Super Bowl 59 on Sunday in New Orleans. The Chiefs looking for their third straight Super Bowl title. President Trump set to become the first sitting president to attend the game in person. That's remarkable, isn't it? Didn't know that.
Yeah, and it is remarkable. It's the reason why Pam Bondi, the new attorney general, and I was at her swearing in actually this week in Washington. The next day, where did she go? She went there to talk to law enforcement just to make sure that this is going to be incredibly safe because the President of the United States is going. I have to say, it is a smart political move. I can't get over how silly it was that Biden decided not to take that Super Bowl interview last year. You know, you're going to have eyes of the entire country on you on Sunday evening.
You know what the eyes are going to be on? So Travis Kelce is going to be playing with Patrick Mahomes and Travis Kelce's girlfriend.
Is this Taylor Swift chat?
Well, you had Trump basically come out and say, I hate Taylor Swift because she endorsed Kamala Harris. They're both going to be there.
So he's supporting the Eagles?
Well, no, he loves Brittany Mahomes and he loves Patrick Mahomes.
He loves
I think
them.
He's going
so
Chiefs.
It's just this real interesting tension because...
Put them in the same box?
Yeah, that's what I think.
I'll tune in for that.
I think that would be good.
I can't believe it's still Sunday night. Are we actually going to do this on President's Day weekend soon? Are we making that change? I think we are looking at making that change, aren't we?
Because you're not going to be able to watch it in real time.
For me personally, I would love to stay up and watch this.
Well, okay, maybe just wake up at 3 and watch the replay with a bowl of chips.
It's not the same, though, is it? You know, you want to live it. You want to live it. Anyway, January payrolls data out in just under 1 hour's time at 8:30 Eastern. Alan Zentner of Morgan Stanley writing the following. Annual revisions typically make the January jobs report difficult to sift through, but I don't expect those to change the underlying picture of a still strong labour market. Ellen joins us now for more. Ellen, good morning. It's good to see you.
Good morning. Happy Friday.
Happy Friday to you as well. We've had some pushback to that strong view of the labour market. We heard from Citi earlier on this morning, who made the case that this is a low-churn labour market. Layoffs are low, but quits are low, and you've seen this on repeat over the last several months. And they make the case that's inconsistent with a healthy labour market. What would you caution back?
We're looking at headline numbers here, right? So you look at 150,000, 180,000, even 120,000, right? Those are strong net job gains. But we economists always want to see more churn in the labor market. It means that people are more have a more healthy view of their prospects of leaving a job and getting another job. There's a lack of churn in the U.S. economy overall. So I don't push back on the city economists saying there's a lack of churn. There's a lack of churn in the housing market. There's just a lack of churn overall. And you want the economy moving and shaking. It means you're on better footing. So is this the best labor market that we've ever had? Probably not. It's slowing, but it's still darn good. And we're going to see numbers that are fine today with some wildfire effects. We are going to have to watch going forward. Federal employees, right? That is going to be a hit. We almost act like it doesn't matter if we reduce government employment. They make more than the median wage in this country. That's still a job. That's still aggregate demand. Now, the ones that are taking the payout, and we said, right, we're almost surprised at how many people have signed up for it. Why not? I mean, for 8 months, you get paid 8 months worth, and it does not bar you from going to the private sector and looking for a job. I would take it.
Ellen Zentner, good to know.
I take
it seems like, on a Friday, you're in the same place that we're in. And I just wonder, especially because you're wearing two hats of chief economic strategist, but also someone who's leading on investing. Do you care about this non-farm payrolls? We've had people come on and say it's just basically an exercise in noise, or it's going to be, as John put it, just a random number generator. The numbers are all distorted. How much is this going to matter?
Look, so I think, the high frequency data can be frustrating, but you step back and they do tell a full picture of the economy. And I am so thankful that we do have the agencies that we do that put out robust data. And yes, I'm sure you've had many guests on talking about the response rates being lower over time and the question of the integrity of the data. But in the United States, we enjoy an incredibly robust landscape of data. And so I do care about today's print, but what it tells me about the bigger picture. And the bigger picture is, again, going back to the lack of churn. It's saying we still have low unemployment rates. We've got natural disasters that knock around the data. We've got government and DOGE that is making for an uncertain environment for employment going forward. But what we know right now is that the labor market's okay. Inflation is coming down. And the Fed doesn't need to do anything for as far as the eye can see.
Where do you expect the lack of conviction that some CFOs have right now because of policy uncertainty, because of a lack of churn, a lack of concrete knowledge of what's to come? Where would you expect that to show up in terms of hiring or investment?
So I think it continues to be the case like today that we're not laying off, but hiring just continues to slow. And so what you look for is that turn when it actually comes to layoffs, because labor is your largest business cost. And if other costs are rising, where are you going to cut? It's always going to fall on labor. And so we're starting to get the first sentiment surveys among business where they're really getting concerned about tariffs and the bottom line going forward. Jobs will be next. So you have to look at jobless claims and see, do those start to pick up?
So policy in Washington could be the catalyst, do you think, for that turn in the labor market?
Yeah, I think right now the uncertainty is over. Is it talk? Is it not? What gets implemented and when? And then if things get implemented, you can start to say, what is that going to mean to my bottom line? And how do I have to adjust costs accordingly?
But if we're just in this moment of basically treading water with policy, uncertainty on where Donald Trump's going to go, what do you do as an employer?
Uncertainty creates paralysis. Uncertainty creates policy paralysis for the Fed. Uncertainty creates paralysis for business decisions, household decisions. It just dampens the overall, underlying, I don't want to say froth, just underlying activity in the economy. And we just sort of hunker down and see what's going to happen. It's just an extremely uncertain year, an extremely uncertain start. I mean, President Trump signed more executive orders in the first 7 days than all of the past presidents in the first 100 days. And you see how many actually get acted upon, not many. And as you stated, right, a lot gets tied up in the courts. But that's the uncertainty.
This is the piece of the tariff story that I don't think was discussed enough earlier this week. Lots of things can happen when tariffs go up. Exporters could drop their prices. But if it ends up with the importers, because by definition they have to pay the tax, they've got one of two options. Basically, pass it on to the consumer. We talked about this. But if you're knocking on the limits of consumer price tolerance, you might have to take it on the margin. And if you're doing that, to Ellen's point, that's where you start to see the weakness in the labour market, because they look to cut costs elsewhere and pull that lever that they've been reluctant to pull over the last few years.
Ellen Zentner repeating something we heard from Jonathan Pingle, where suddenly those unemployment claims become that much more important at a time where people are looking for that signal that that's the lever people are pulling.
Ellen, just a final question. You mentioned the wildfires. I was surprised it didn't come up in the news conference. How much disruption are you expecting from the wildfires, from the cold weather, particularly on the East Coast, over the past few weeks?
So I think it could be as much as, say, 40,000 off the top of payrolls. I mean, the thing is that we're going to get that within a report with annual benchmark revisions as well. So sifting through what that means, very difficult. But I think the overall number we're going to see is still going to be an okay number, and then you just assume it would have been higher if not for the wildfires. Does that mean the wildfires don't matter? Absolutely not. I mean, these people are displaced. They have to go somewhere. And these climate events are creating a lot of regional displacement around the country. We're still seeing it from the hurricanes last year. It's the fact these things are back to back to back. We're not just dealing with one major climate disaster here and there. These are things that are coming back to back, and it's extremely disruptive.
We're expecting a big effort from Mike McKee at 8:30 Eastern Time, going through all these details. Ellen, it's good to see you. As always, thanks for dropping by. Thank you. Ellen Zentner there of Morgan Stanley. The jobs report just around the corner, about 46, 47 minutes away. Let's get you an update on stories elsewhere in the meantime. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. President Trump fired the head of the Federal Election Commission, but she doesn't plan to leave. In a post on X, Ellen Weintraub wrote, "There's a legal way to fire FEC commissioners, and this isn't it." Weintraub was appointed to a 6-year term more than 20 years ago. Under federal law, commissioners are allowed to stay past their terms until a replacement is named. Apple is getting ready to unveil a long-awaited overhaul of its low-cost iPhone SE. The new model is expected to be unveiled next week and go on sale later this month. The new model will include Apple Intelligence and is expected to be more expensive than the current SE model, which sells for $429. And Los Angeles Dodgers star Shohei Ohtani's former interpreter Ippei Mitsuhara has been sentenced to 57 months in prison for stealing $17 million from the baseball star. He was ordered to pay Ohtani back and pay back over $1 million to the IRS. Lawyers for Mitsuhara blamed a gambling addiction and had requested a much shorter 18-month sentence. That's your Bloomberg Brief. John?
Yahara, that's how rich we need to be. So rich that you don't notice $17 million has gone missing. Can you imagine?
Is that the metric now that we have?
Absolutely.
Yeah, well.
That and buying Ken Griffin's dinosaur, right? Those kind of fossils.
Oh, yeah, that was cool.
That was cool.
That was
right?
cool.
It's like
if you're a kid and
a
you
childhood dream.
Exactly. My nephews looked at that and they were like, I want a dinosaur.
What would you do if you won the lottery? Buy a dinosaur, right?
Go to space, buy a dinosaur. You know, some things don't change.
Up next on the program, we'll talk dollar strength.
The strong dollar policy is completely intact with President Trump. He re-emphasized the importance of maintaining the dollar reserve currency status.
That dollar getting a little bit weaker. We'll catch up with Jane Foley of Rabobank in just a moment. From New York, you're watching Bloomberg TV. Equity futures on the S&P totally stable and unchanged. Still going towards a week of gains on the S&P 500. The Nasdaq 100 going nowhere as well. On the Russell, the small caps just about positive by not even 0.1%. The main event, of course, is a little bit later this morning at 8:30 Eastern Time with the payrolls report just around the corner. Let's talk about the bond market. So much attention on fixed income this week. Thank you, Treasury Secretary Scott Bessent, making a point that him and the President of the United States are very focused on the 10-year yield and not the rate at the Federal Reserve. That's a shift of emphasis from this administration.
What he wanted to focus on was the mortgage rate and the effective rates that people borrow at, saying that that's going to be the true tell. And he pointed to the idea that the Fed cut by 50 basis points and caused the real borrowing costs to go up. That's the reason why they're so focused on that.
The 10-year 4.43. Out of surveillance this morning, dollar strength.
First of all, the strong dollar policy is completely intact with President Trump. And I was very happy at his Economic Club of New York speech in August when he re-emphasized the importance of maintaining the dollar reserve currency status.
So here's the latest this morning. The US dollar poised to end the week just a little bit weaker amid tariff uncertainty and just ahead of the payrolls report in about 40 minutes' time. Jane Foley of Rabobank writing, the political news flow in the US combined with Friday's US jobs data release suggests plenty of scope for volatility in the dollar crosses. Jane joins us now for more. And Jane, we've had exactly that over the past week or so. On Monday, a lot of it was trade related against the peso, against the loonie, saw a bit of it against the euro as well. But the one to watch, and I think we're both on the same page, I think we all are, the one to watch has been the Japanese yen over the last month or so. Jane, what is behind that big move?
You know, I couldn't agree more. I think the yen is by far the most exciting currency this year. And we've seen that in its performance. It's been the best performing currency in the year to date. And that really is related to the market revising, taking another look at its expectations about Bank of policy or Bank of Japan interest rate policy. We've had a couple of speeches, for instance, which really have steered the market at what they really need to be looking at. And that isn't necessarily the workers' real wage numbers. It's the household wage numbers. There's been real changes in the Japanese demographic, more part-time workers going in, which has affected those numbers. And the market, as a consequence, is viewing the Bank of Japan in a more hawkish light, more interest rate hikes coming, and, a better outlook, really, for the Japanese yen.
Jane, do you expect the volatility to be in specific pairs and not necessarily just driven by the fact that the dollar is going to continue to strengthen ad nauseum? And I'm talking about this in the same light that the ECB might take a page from what we saw of the Bank of England and cut rates even in the face of somewhat stickier inflation.
I think there will be a lot of volatility, probably predominantly in the dollar crosses, but there is a lot of news flow elsewhere. And of course, you mentioned at the ECB. You mentioned the euro. We, of course, have Germany really mired in pretty weak growth. We've got political issues, France and Germany. France, of course, having good news this week in the shape of its budget, but there really is still a fragmented government in France and probably in Germany as well as we go on. And that's not a great situation for Europe. It's got a weak leadership in its primary countries of Germany and France at a time when Trump is threatening the EU with tariffs. So a difficult position, I think, for the Eurozone, and therefore the possibility of more volatility from euro-related factors, irrespective of the politics in the US.
Jane, just a final question on Europe. Plenty of debate over on the continent today about where the neutral rate might be. I'm not sure why we're still having a conversation about neutral at the ECB when some people might suggest the economy is weak enough to have a real conversation about getting accommodative and maybe getting accommodative quickly. Where do you stand on that?
Well, we are having that conversation. I think we've been having that conversation, for quite a while, and we'll have that conversation irrespective of exactly where that neutral rate is, because you've got to remember, that will change over time. So it's only a basic concept anyway. But, one thing that the ECB, has really got to and is very wary about is the possibility that inflation could remain sticky. And that's what we still have in Europe, in the UK and in Europe. And that is going to be potentially a break on some of the expectations that growth will fall and create a faster pace of easing in these central banks, both the ECB and the Bank of England.
Jane, appreciate your time on the FX market. Some big moves over the past month in dollar yen. Jane Foley there of Rabobank. Just finishing on the euro, I want to return back to the United States. When we closed out 2024, we were having this massive conversation about sequencing. It wasn't just policy changes, but the sequencing of those policy changes that mattered. And we're getting an idea about sequencing. We're leading first with trade. And then we're shifting towards taxes. I think if we started with taxes and moved aggressively on that, we'd have a different conversation about where rates need to be, what the dollar's going to be, about how hot this economy might be running. But because we started with trade, the conversation naturally drifted. I would say it's way too early in the year and far too early in the administration to draw any conclusions right now and extrapolate them out. If you start to come through with a big tax package and Republicans start to get on side about what that tax package might be, its size, and where the focus will be, all of a sudden we shift back to where we were at the end of 2024. Running the economy hot, potentially being constrained by the bond market, plenty of dollar strength and sucking all that capital in from the rest of the world. That conversation can shift really quickly.
Right now, people are not seeing the gravitational force to push through a tax bill in short order that could potentially support that type of running the economy hot. The fact that we were even having a discussion earlier about whether this would be a tax bill in 2025 or 2026 gives you a sense of the messiness that people foresee with this process. It is easier to have an executive order about tariffs. It is much harder to pass through a bill with all the potential interest involved, even throwing a lobbing in the carried interest tax. I mean, it just highlights how much you're going to have these hot potatoes that might not make a huge difference on the budget deficit side of things, but that do make a huge difference with respect to people's emotions.
In early November, the emotions were around a tax bill that might take several months. Get it done really quickly, hit the ground running, one big, beautiful bill. And here we are talking about the potential of it drifting into 2026. Terry Haines of Pangaea made the point, there are too many reasons behind the President of the United States, too many reasons, too much emphasis to not get this done in 2025.
This is all true. The longer it drags out, the more we're talking about uncertainty. And even if policy isn't great, companies want certainty more than anything else.
And the conversation shifts back to the data. 8:30 Eastern Time, 34 minutes away, the jobs report. Joining us, Nadia Lovell of UBS, Mike Collins of PGIM, Torsten Slok of Apollo, Jeff Rosenberg of BlackRock. From New York City, the third hour of Bloomberg Surveillance. Up next.
I think the most important is the labor market.
I think some of the data has been overstating the health of the job market.
We're going to see more challenges to labor supply.
We would expect the unemployment rate to go up if the tariffs against, Canada, Mexico, China are in fact sustained.
Going forward, I do think that you'll see a payroll impact estimate from slowing immigration, but it'll be kind of harder to figure out how that happens to actual unemployment.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The jobs report 30 minutes away, 8:30 Eastern Time. It drops. The estimate, the number we're looking for, 175. The high out there at the moment, 240. The low, 105. The equity market doing nothing going into this. Equity futures totally unchanged on the S&P 500, on the Nasdaq, and on the Russell. We're just about positive by 0.1%. The one to watch may be the bond market. The 10-year right now, Lisa, 444.
It is just really shocking to think about how far we've come from the last jobs market report. When people were worried or concerned that maybe we got a reacceleration in inflation and that yields would climb much more significantly and that maybe we were running this economy too hot. That has been taken out. This is a market that is girding for some potential evidence of cracks in the labor market that could undermine the American exceptionalism story. Barring that, it might not make a dent in markets.
Might not make a dent, but Jonathan, you were right. Maybe we need to look at the bond market because is that going to be the regulating force on some of these policies that we want, that this administration wants to enact? And they added to that list last night when it comes to their tax policy. Everyone's talking about the uncertainty of tariffs. We have some of the bad news. They want to see the good news. So the reaction to the markets is going to be more interesting than the actual NFP number.
Caroline Leavitt, the press secretary, coming out with a long list outside of the White House yesterday. The president's tax plan to end taxes on tips and overtime, new cuts for Made in America products, extend TCJA from 2017. You're all familiar with that. Expand the state and local tax deduction. And the list just kind of goes on and on.
There are things that potentially could be offsets, but they're minor. The rest of them are all saying, you get a tax cut, you get a tax cut, to Anne-Marie's point about an Oprah Winfrey tax season. How much gets passed and what does that do to the budget deficit? And does the 10-year respond to that in a significant way? We'll have to see.
And I love the carried interest loophole. This came out of nowhere for the Republicans. The Democrats couldn't do it when they had power. Someone writes in, all someone needs to do is interview Steve Schwartzman about carried interest and the elimination chatter will be over. I tend to agree.
Over for who? For the President of the United States, for members of Congress? They'll face midterms. They're only just around the corner. If they don't get something done on taxes, there'll be big pressure on them. These were big campaign promises from the president, and they were very well supported.
Big campaign promises, and everyone thought the idea of no tax on tips was going to go away after the election. He has brought that up constantly. That is going to have to be in this bill if he's the driving force behind it.
So the economic data so far this week has been softer than expected. It started with jobs openings, then it went to the ISM services, prices paid pulled back, good stuff. Still in expansionary territory. I don't think there's anything to worry about here. Jobless claims a little bit softer, but the heat comes out of the American economy. How long before the heat comes back in and we start talking about rate hikes again? Torsten Slok of Apollo, you seen this morning? Published this. The last Fed cut was in December, and the number of months from the final Fed cut to the first Fed hike has historically been as low as 7 months, implying that the Fed could hike rates in June.
What would it take for them to have to do that? Right now, they are completely on hold. Most of them are leaning still to the dovish side of cutting. You did get some Lori Logan speak talking about maybe we're at neutral and there could be an equal opportunity on both sides. What kind of policy would have to come through for the Fed to really put a hike on the table? And what kind of runaway increase in longer-term yields would you have to see where it would be politically feasible for the Federal Reserve to hike rates?
What kind of number would we have to see in 26 minutes? I'm not sure any kind of number.
Come on. You think that if we get 600,000, they're going to be, we're hiking. No, they'll say it's fictitious.
How many people are going to believe that number?
Exactly. It'll be a fiction.
We're on the same page. I'm not going to argue. It's Friday.
But we can make it exciting.
We can. You should try. Maybe try harder, given the job you've done so far this morning. Coming up this hour, Nadia Lovell of UBS saying stocks still have room to rally. We'll catch up with Torsten Slok of Apollo with US payrolls just ahead, and Jeff Rosenberg of BlackRock on a Fed that is in no hurry to make another move. We begin this hour counting you down to the latest payrolls report due at 8:30 Eastern Time. Nadia Lovell of UBS writing, while we think there is more to go in equities, we emphasize the importance of diversification and hedging strategies to navigate policy uncertainty. Nadia joins us now for more. Nadia, good morning.
Good morning.
Before we get to the policy uncertainty, let's talk about payrolls. What are you looking for in 25 minutes?
As you said, the numbers are noisy at the start of the year, and so, probably close to 200K. But as we've all noted, that this might not have any indication for the market. I think that, even Wallace has put more credence on something like JOLTS. I think that's more indicative of where the job market is. We've seen a little bit of softening, nothing falling off of the cliff. And so we'll see.
So that repeated in the ISM. So that repeated to some extent in jobless claims as well. What kind of economy is this president inheriting in 2025?
A pretty strong one. I mean, you saw a fourth quarter GDP above trend. We're looking for above trend growth to continue this year. The job market, again, as we know, remain healthy. And I think despite all the tariff noise we saw earlier this week, ISM manufacturing finally back in expansion territory, and we have 3 months of new order, above 50. And so I think that was missed to show that the fact that you could start to see some recovery in the manufacturing side of the economy. And so overall, the economy seems to be on good footing.
Which is the reason why, and you came in, and I'm going to steal some of your thunder, you were talking about some of the investment, the capital expenditure investment that some of the big tech names were coming up with, $100 billion, $75 billion just for this year alone. Where is that money going? Are we going to see that giving some jobs boost or some sort of manufacturing boost to the rest of the economy?
We are seeing, and we saw that last year as well. I mean, we ourselves coming out of the earnings season had to lift our capex expectations for the full hyperscalers. I mean, before we were looking for 25% growth this year, and we're now looking for 35% plus, and that's over $300 billion. And so we think that will benefit the data centers, the enabling layer of the AI story, which we think has disconnected the pressure that we've seen over the last week, particularly around DeepSeek. So the fact that the hyperscalers are spending more should mean a lift for things like semis in terms of earnings.
Then do you think that it is a mistake that this market is more focused on the possibility of cracks in this labor market than the idea of a reacceleration like Torsten Slok was talking about?
Reacceleration is possible. I think that yes, I would agree that the labor market or the economy itself has not seen any major crack, and we have a potential for a reacceleration. Of course, that has some concerns around inflation. Inflation right now seems to be coming down. We think that it will start to come back down again, and we think that you could get to core PCE, sort of around 2.5% by the time we get to the mid-year. We don't expect the economy to overheat. I think right now companies themselves as well are in sort of some companies are in a wait-and-see mode to kind of see where policy eventually shakes out, particularly government policy.
And when it comes to tariffs, and it's something
Absolutely.
you have a lot of thoughts on. You say you're expecting aggressive but selective.
Yes.
Explain.
Yes. So we are expecting selective tariffs, not universal tariffs. What we're looking for really is lifting the effective tariff rate for something like China. We think that that's likely going to triple to close to 30%. Now, we think that the president will continue to negotiate with some of our close neighbors like Canada and Mexico. We see that grace period has been given to those two countries. We'll see what happens after 30 days, but we're not expecting any sort of significant tariffs against Canada and Mexico to really stick. It's just really complicated. How the complexity of enforcing that, particularly in something like autos that crosses the border multiple times.
Right, and we already are in a trade agreement with both these two countries,
Exactly.
but the trade agreement's coming up, so maybe this is an opening salvo into those conversations.
To pull forward that.
You didn't mention Europe, though, and the president says the European Union's next. What are you expecting?
10% has been floated out there. We do expect some increase in Europe, but again, I think China is really going to be the focus. We're all watching, of course, the April 1st deadline. We know that the president has asked the federal agencies to come back with reports for countries that we have major trading deficits with. And a lot of those countries are really in Asia.
Well, Chris Verrone was on earlier, and he talked about Christine Lagarde, talking about peak pessimism. So he wants to be exposed to Europe. Would you want to be exposed to European equities now ahead of tariffs?
It's a great question. We actually have a call on Germany, the DAX specifically, a tactical call around that we put in place back in December, again, ahead of the German election in a couple of weeks. Also, you could get some sort of, this chatter of some kind of peace agreement between Ukraine and Russia that still remains to be seen. And so you also have this election with a lot of the candidates having a pro-growth policy. And again, as I noted earlier, we know that Germany has a lot of exposure to production, and with ISM manufacturing starting to pick up, even some of the companies are suggesting a bottom in terms of the inventory cycle as well. Like that could be beneficial to Germany.
That's quite a call. You're up 10% on the DAX so far this year. Euro Stoxx 50 is up by more than 9. When do you close that, if it's tactical?
We'll see what happens after the election. But when we think about tactical, we're thinking about 3 to 4 months.
OK. Were you thinking about 10% upside when you initiated that
call? No, it's coming in better than we thought. We were not looking for this sort of massive outperformance versus the U.S. market, but we'll take it.
At the same time, I want to go back to something that Chris Verrone was talking about, and it relates to the money that's going into the DAX and the money that's going right now into the entirety of the European market, which is follow the flows. And the biggest trend has been to him the dollar yen, and the fact that suddenly, after years and years of money moving from the east to west, we're starting to see a shift. and it's because of some fundamental reasons. And that's going to lead to an outperformance of the rest of the world versus the U.S., which is highly valued. Do you believe that this is the beginning of something that is more sustainable in that type of way?
No, we continue to think that the U.S. will outperform. There will be pockets in which these other regions outperform, like we're seeing with the DAX. But we ultimately think, fundamentally, when you look at our exposure to tech, particularly, the spending that is happening there, the AI story that we think remain intact, and that ecosystem, not only tech but also industrials, as well as the utilities companies as needed for this infrastructure build out. We think that the U.S. stands to benefit.
So a lot of people have wondered if the utilities play was done because of some of the deep sea concerns and this idea that maybe it would be less energy intensive. You push back against that. You think that that's absolutely the wrong take. Why?
Well, look at it, right? Last week we saw, some of the independent power companies down as much as 30%. They're not down so much anymore. So that correction has been bought right away because it does not change the dynamics that there's an increased need for energy. And it's not just about AI. It's sort of the energy transition as well. It's, cloud computing, it's quantum computing. There's all of this technology that's going to be needed that increased power is required. And so we continue to advise our clients when you see that disconnect in the market, disconnect from fundamentals, that is a buying opportunity, despite the fact that we think that volatilities, you have to use those opportunities to get into things like the utilities, particularly the independent power companies.
Nadia, love doing this with you every first Friday of the month. Nadia Lovell there of UBS. Thank you. Thank you very much. The jobs report just around the corner, 8:30 Eastern time. The estimate 175. Just got a message. Eggs secured over at Whole Foods. Managed to get some. So there you go.
Eggs secured?
Eggs secured.
Oh, yeah?
Just getting a confirmation right now. A dozen.
A dozen.
How much?
Yeah, that's the real
I haven't got a
cost.
price in front of me. I can share that with you in the commercial break.
This is literally what we were talking about yesterday with the idea of someone stealing the eggs from the truck and then offering them to you on Canal Street.
Do you want me to sell you
You're
some
basically getting people pitching you. The eggs are secured. Where do you want to meet?
I'll be on Canal Street this weekend next to the guys selling the Gucci handbags.
You got the stuff?
I'll be dealing some eggs on the corner.
The stuff.
Yeah, all right. Let's get you an update on stories elsewhere this morning. I won't, obviously. I'll be eating them. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. We start with President Donald Trump's tax priorities, which you were discussing earlier. He outlined what they were in a meeting yesterday with Republican lawmakers. Trump called for the end of the carried interest tax break enjoyed by private equity and wants to cut special tax breaks for sports team owners. He also pushed for the expansion of the SALT deduction. Meanwhile, the Israel Defense Forces says its Air Force conducted a strike in Lebanese territory on 2 military sites. The IDF says the sites contained Hezbollah weapons, which is a violation of the ceasefire agreement. And a plane carrying 10 people went missing in rural Alaska on Thursday during bad weather. The flight from Annaliklit to Nome is likely the third deadly aviation disaster in the U.S. in just 2 weeks. The Associated Press reporting that rescue crews are scouring the ground for any sign of the wreckage of the Cessna jet. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. That's tough to hear. That really is. More from Yahara in about 30 minutes' time. Up next on the programme, the morning calls. Plus, we'll catch up with Michael Collins of PGIM, fixed income, drum beating to the payrolls report. The payrolls report 16 minutes away from New York. You're watching Bloomberg TV. The jobs report is 13 minutes away. An hour after that, the cash open. Dictating the price of things will be that jobs report, because right now this market's going nowhere. Equity futures totally unchanged. In the bond market, we're going nowhere too. The 10-year 443.83. The arms are crossed. Ramos hyped up.
It's Friday, Bravo.
Hold on a second. I think that there is a tell in the fact that people are sort of paralyzed. That people don't have anything to say about non-farm payrolls.
We see this every month, don't we?
We sort of. It has a different tone to it because there has been this exhausting running in place where you're trying to play whack-a-mole with all the different proposals, game out what they could potentially mean, and then they all get disrupted in the next 2 seconds. So, if we get a headline number, we've just heard 15 people tell us that it's fictitious because the people will explain it away. It becomes very hard to even know where to begin to look.
Payrolls deniers aren't new. Okay, that's been an industry for a long, long
Payrolls
time.
deniers.
Yeah, that's what they're called. The payrolls deniers.
Oh, is that right?
Yeah. They've been around for years.
Okay.
That's not new. I think what's new and why we're taking even more less emphasis away from this jobs report is the expected policy changes from the administration. Policy is just absolutely paramount. And I'd say also, because of the Federal Reserve, has to take a back seat to what's going to happen with fiscal. So I think it's policy from the White House and Donald Trump, the president.
You add on top of the policy uncertainty the fact that they're going to revise it by almost 1 million jobs, and the fact that all these numbers have gotten pretty messy because you haven't gotten the same kind of response rate. It makes for rather dizzying Friday.
And the accusation that they were inflated for political reasons,
well,
like payrolls deniers.
Okay, but
make NFP great again.
I'm not saying I buy it. I'm just saying that industry exists. Same group of
There's
people.
an industry for everything.
Every single month, of course.
Including eggs.
Let's get you some morning calls, including that too. First up, Wells Fargo cutting its price target on Amazon to 207, citing slowing revenue in Amazon's cloud division. That stock is down by 3%. Your second call from Citi, downgrading Nike to neutral, noting a lack of new products and continuing top-line pressures. That stock is down by 0.6%. And finally, Morgan Stanley downgrading Alf Beauty to equal weight and slashing its price target, highlighting category weakness and volatility in the space. That stock is getting hammered. In the pre-market, it's down by 25%. Let's turn back to the labour market. January payrolls just moments away. The estimate in our survey expecting 175,000 jobs and unemployment to hold steady at 4.1%. Joining us now is Mike Collins of PGIM Fixed Income. Mike, welcome to the programme, sir. Good to see you. What are you looking for in 11 minutes' time?
You know, I have no idea, Jonathan. It's a total crapshoot. And to your point earlier, I think the markets are really taking it with a grain of salt. You know, there are so many big revisions that are going to be associated with this. And remember, these jobs numbers, when we get them first Friday of every month, they are backward looking. And then they do get revised as well going forward. So it's all about where the economy's going, where the labor market is going, and where inflation and obviously interest rates are going over the next 6 to 12 months. And again, I think we've had a big retracement in rates, and it feels like we're getting closer to the high end of fair value here.
Mike, I was hoping that you would come out and say this is actually going to be a really important jobs report. I personally am looking forward to it and have so much to say about it. I do think there is something that is incredibly telling about where markets are positioned. And Priya Misra nailed this when she said, it seems as though there is an asymmetrically positioned market to respond much more to a downside surprise than an upside surprise. Putting aside the noise and all of the confusion around these particular numbers, Mike, do you agree with that right now this is a market that feels like there isn't necessarily a risk of overheating, but there is a risk of cracks forming in the labor market?
Yeah, I'm definitely in that asymmetric camp with Priya as well, Lisa. And I think it's really a function of what's priced in, right? Like right now, there are 2 Fed rate cuts priced in sometime in the next 12 months, and then that's it for the next 10 years. Okay, so there's very little movement to the upside here at risk. I mean, yeah, you could retrace back to that 480, get into the 4.5 to 5 zone on the 10-year Treasury. I call that the overshoot territory. That's a zone where rates are way too high and unsustainable. I think 3.5 to 4.5 is kind of the big fair value range on long-term 10-year Treasury yields. And personally, I think the 10-year Treasury is going to spend more time in the bottom half of that range from 3.5 to 4. So we overshot, and we've overshot a couple of times in the last few years, and it doesn't stay up there for too long. Now, even close to 4.5, rates are clearly in the buy zone. And think about the downside risk. We just talked about the upside. If there is a downside surprise in the labor market, in growth, in inflation, in geopolitical risk, in policy risk. I mean, those 2 cuts that are priced in, could turn into, 8 or 10 pretty quickly because that's the kind of dry powder the Fed has, right? They could get, cut 200 basis points overnight if there was a real disaster and get to a rate that they would probably kind of think of as being long-term neutral. So that's the kind of dry powder. So that's where the asymmetry comes in.
Mike, I know you are bullish on bonds, on longer-term bonds, and I know that you have been for a bit. How much more conviction did you get that you had the President of the United States say that he thought the Fed made the right decision, and you heard Scott Bessent, the Treasury Secretary, come out and say he's much more focused on the 10-year yield than jawboning the Fed in one direction or another?
Yeah, I think that's really good news, right? That they're backing off the Federal Reserve. That's what they're supposed to do. They're supposed to let the Federal Reserve be independent and do their job. So that's really encouraging from a financial system standpoint, and it's really good for the long-term path of the economy and inflation, Lisa. In terms of the 10-year, yeah, if I had all of the debt that the government has, and Trump is knows debt as well as anybody, I would want lower interest rates too, right? Like I said, I think these rates are just unsustainable. Look at the deficits we have and the debt load we have and the level of interest rate we're paying, right? So it's that multiplication, that factor is the debt service that we have to pay every day, every month, every quarter. We're doing 125 billion in new auctions next week, right? It's just nonstop. And at some point, something has to give. Either the debt has to come down, or the interest rate has to come down, right? And we all know which one is the variable that's going to move the most. At some point, I don't know if it's next month or in 10 years from now, at some point, that level of interest rates will have to be probably a lot lower. And you're seeing that in other countries with a lot of debt, right? Like, obviously, Japan's raising a little bit, but our yields are still almost 4 times theirs. In China, our yields are almost 3 times Chinese yields, and they've been cutting because high debt levels just can't be sustained with high interest rates in an economy where growth is moderating.
Mike, that's music to the president's ear. Good morning, Mr. President. Balanced budget, all these exclamation points is what he woke up to his first Truth Social today. If you could get policy certainty today, because you don't really care about the jobs report, on all these ideas floating around Washington, D.C., what would it be?
If I could get policy certainty, I mean, any certainty is better than uncertainty, right? The markets, as we all know, hate uncertainty. I mean, some blend of higher revenues coming in, whether it's through tariffs or better growth, i.e., through deregulation, and, just better, corporate earnings through tax cuts, et cetera. I mean, you have to balance those, and Trump does understand that, right? It is a balancing act. The whole sum of it has to be lower budget deficits, right? I would love to see a balanced budget. The problem is to get there quickly is almost recessionary. I mean, to cut as many expenses at the government level, and you're seeing it, anecdotally already. These are pretty high-paying, secure jobs that are being eliminated. It will hit the economy, right? And you're already seeing, the combination of tariffs potentially, immigration reform, et cetera. It could result in higher inflation and lower growth. Right, that's a really brutal combination. That's kind of what the UK is going through right now, right, and that's why the Bank of England is painted into the corner a little bit, because that stagflation risk is brutal. Nobody wants that, because that's a world where the Fed kind of gets stuck and can't support the economy because inflation is sticking. Nobody wants that. So it's a real tough balancing act, and I wouldn't want to be in Trump's shoes.
Mike, we've got to go. You're going to stick with us in 2 seconds. Give me a number. The estimate's 175.
Oh, I have no idea, Jonathan. I mean, I'll take the under. I'll take the under.
Mike Collins of PGIM is going to stick with us. So we had yesterday Sonia Meskin of UBS calling it an exercise in forecasting noise, and we just heard from Mike Collins of PGIM who called it a crapshoot.
Yeah,
right?
Basically. I don't know. John, why are you asking me these questions?
What a promotion for the payrolls report that drops in about 4 minutes' time. From New York City, this is Bloomberg. Following days of breathless promotion, here it is. Ridiculous. The jobs report drops in about 20 seconds' time. Equity futures at the moment negative by 0.1%. The Nasdaq also down by 0.1. In the bond market, the scores look like this: 2-year, 10-year, 30-year. Your 10-year yield at the moment just about unchanged at 4.4363. The jobs report, the number we're looking for, the estimate 175. With the print is Mike McKee. Good morning, Michael.
Good morning. We come in a little bit light this month, 143,000, and last month revised up to 307 from 256, which we all thought was really big at that time. The unemployment rate, it goes down by 0.1 of a percentage point. Now, remember, we have revisions to the household survey. We'll have to see if that figures into it, but it is still showing a tight labor market. Change in non-farm payrolls, as I mentioned, to 143,000. To that, you have to add 100,000 more in terms of revisions to November and December. The private payrolls go up by 111,000. Manufacturing payrolls up by 3,000. Remember, ADP had said we lost 13,000 jobs there. Average hourly earnings extremely strong, up 0.5% last month, and the forecasts were both for 0.3. That pushes the average hourly earnings on a year-over-year basis up to 4.1% from 3.9%. And as I mentioned, the unemployment rate, 4%. Labor force participation rate goes up a tick, 62.6. All of this to suggest that maybe what we have seen here is the Biden administration go out on a high note. It'll be very interesting to see what the White House, the current White House, says about all this. In terms of the revisions, payroll employment for November revised up by 49,000, December by 51,000. That's how we get the 100,000 total. And then a quick look at the revisions. We are looking at a level 511,000 below what we had for the year prior to this. That's over all of the months. They divided out over the months of the past year, and we do get some negative numbers here, I believe. No, not even October. October we go up. Some people thought that one might be negative. And then in terms of the population controls, population changes 2,871,000. That is much lower than the 3,047,000 that they had already thought. So your difference is 176,000. Now, all those revisions essentially meaningless to the Fed. It will get some political talk, but the bottom line is hiring a little weaker, but unemployment 4.0%.
Mike McKee, thank you, sir. We'll leave it there. First look, then, this is how we'd frame things. A tug of war between a downside surprise on a headline number and a much hotter than expected wage report. Wages, average hourly earnings month over month coming in at 0.5%, the estimate 0.3. The headline payrolls number 143, the estimate 175. So who's winning in the tug of war? Check out the bond market. First look. At the moment, wages are. Yields are higher by about 4 or 5 basis points through the curve. At the front end, the 2 years up by 4, the 10 years up by 5. That's driving some dollar strength. The euro back down to about 103.50. And in the equity market, we'll pull back a touch, but not too much. We're down by about 0.2%. So I would say not too much drama here, Lisa. But I certainly, in the early part of the read of this jobs report, put a little bit more emphasis on what we're seeing on wages.
Other than the headline number, it's a screamingly bullish and actually hawkish report. Not only all of the things that you mentioned with hourly earnings, but the unemployment rate fell to 4% from 4.1%. This is going in the right direction for a fully employed America, the wrong direction if you're counting on the Federal Reserve to cut rates. The labor force participation rate went up. All of these numbers point to the idea that people are coming back into the workforce, unemployment's coming down, wages are increasing. Problem is the headline number, which we've already talked about ad nauseum, tends to be pretty messy.
Just a bit softer than expected. Mike Collins joins us now of PGIM Fixed Income. Mike, just to go through it again, downside surprise on a headline number, but wages come in a bit hotter. On the earnings side of things, month over month at 0.5%. How would you frame this report?
Yeah, I think it is another sign that the economy continues to be really resilient, right? It's been a really strong economy, Jonathan. We've just had, a 4-year GDP boom in this country like we've really haven't seen since just after World War II. We've had this kind of post-war, post-pandemic boom. Nominal GDP is up over 40% in 4 years, which is just remarkable. And you're seeing a continuation of that here with, wages continuing to be somewhat sticky, growth continuing to be pretty robust. You have to look at those hours worked, right? Those are down. If you multiply the wages times the hours worked, which is really important, that's how you calculate all, consumer income for the whole economy. It's probably a little bit weaker. So again, these headline numbers are moving all over the place. There are a lot of revisions and some to come, but it's just another sign that the economy continues to do well. Now look at the stock market reaction. It's a little negative, right? And I think that's a sign that higher rates again, rates going up, good news in the economy means the Fed has less of a likelihood to cut is really not good news for risk assets, right? Risk assets can only kind of really do better from here, I think, if you have a moderation in the level of interest rates, because like I said earlier, it just adds too much pressure to the overall economy.
Mike, then are you basically saying you disagree with Lori Logan that this might be around a neutral rate and that actually it still is restrictive, and as long as we stay in this area, you're going to see an ongoing grind weaker in the economy?
You know, I agree with her in that the Fed's on hold, right? They are totally on hold right now. They're on ice. They may not move at all this year. It was probably a really high probability. And if you really look at what Lori said, it's really focused on the current environment. Like right now, the Fed is more likely to just sit on their hands. I totally agree with that. But I think even Lori and certainly Powell agrees that over the long term, rates are meaningfully restrictive, right? Probably, easily 100 basis points too high. So that is the path of least resistance, but maybe not this year.
Mike Collins, appreciate it, sir. Mike Collins there of PGIM Fixed Income. If you are just joining us, the number 143, that's the headline payrolls print, the estimate 175. Lots of attention at the moment on the earnings side of the picture, coming in hotter than expected at 0.5% against an estimate of 0.3% month over month. The first move, and as we always stress, not necessarily the right move, and we'll see if this sticks. The 10-year yield is higher by 4 basis points, the 2 years up by something like 3. It's not hot enough to hike. The Fed still has a bias to cut. I'm not sure this data will constrain them one way or the other. But if you're an investor right now and you're looking at this, things are still OK based on this report.
Things are still OK if you're counting on companies continuing to do business and invest. Things might be a little less OK if you're a stock investor in some of the highest valuation stocks that have been depending on rates going lower. That ship increasingly seems to be sailing of rate cuts this year.
Torsten Slok of Apollo joins us now for more. Torsten, good morning, sir.
Morning.
We've got a few minutes to go over this one. What's your first take?
Well, a very important backdrop for this is that the framework the Fed uses for evaluating whether they should be hiking or cutting is the Taylor rule. And the Taylor rule has on the right-hand side 2 variables, namely unemployment and inflation. And both these components, namely wage inflation and unemployment, are actually pointing in direction at least of the Fed staying on hold. Obviously, this is not enough for them to begin to hiking. But at the end of the day, the tailwinds to growth continue to be very strong. We have an AI and data center boom. We have strong defense spending. We have strong tailwinds also from the CHIPS Act, the Inflation Reduction Act. And we also still have relatively elevated stock prices and home prices, all things that are supporting the U.S. consumer. And even before we didn't know what Trump will do and what he announced on the tax policy yesterday, if we do get lower taxes on Social Security, on overtime, on tips, other things, this would also be a tailwind to the outlook. So it's not clear at all that the Fed is done. And for now, I think it will be that they will be keeping them on hold. But the door is still open to hikes coming later this year.
Recent communication certainly suggests they'll be on hold. Implied in their outlook still, and their communication as well, is a bias to reduce interest rates. When you say there is a chance to hike, I understand from what we've heard from a lot of people on this programme, the bar to cut has got higher. But it's the bar to hike a whole lot higher. How low is that bar?
But think about it. Since the election, we have certainly seen animal spirits increase quite significantly. If you look at CapEx plans from the regional Feds, they have all started to reaccelerate in the last 2 months. We've seen very strong improvements in a number of sentiment indicators, all pointing towards that there is still a chance that now there may be in the business sector in particular, the feeling that, well, maybe we should begin to hire more, maybe we should begin to spend more in terms of CapEx. So it is still true where we sit today. The bar is high because the expectation is that inflation will continue to come down. But inflation today is still roughly at around 3%. So we're not near the target. And the trend in the last few months on a year-over-year basis has been up. So if you take both inflation and the labor market, in particular the unemployment rate falling and also wage growth as high as 4.1 on average hourly earnings, those are very important indicators for the Fed when they think about what they want to do.
A lot of independent indicators for wage growth don't show that same kind of heat. And as we heard from Mike Collins, some of this has to do with just the hours work coming down. And when you do the multiplication, that's what ends up happening, is that you see that kind of wage growth. I'm just wondering, are you seeing other signs of inflation picking back up, other than eggs, that really could be sustainable in an economy that otherwise seems increasingly concerned about disinflationary degrowth impacts?
So some of the indicators that have come in again since the election is ISM services prices paid have really jumped higher. You also see NFIB planning to raise average selling prices have also gone higher. And the home-based data, which is much higher frequency for the labor market, is also looking a lot hotter. So there are various indicators that certainly suggest that it's not clear that this narrative is that we are in a territory where monetary policy is very restrictive. If monetary policy was so restrictive, why is the unemployment rate going down? The unemployment rate should be going up. So in that sense, there's a lot of conversations around still. Is it really the case that we are in restrictive territory? In particular, again, with policies potentially coming not only on tariffs, but also potentially coming on restrictions on immigration, and also policies potentially coming in the last few days on tailwinds to fiscal policy.
If this is actually true, that the Fed could hike rates and that policy is not restrictive in any way, does it make sense to you that stocks would fall if benchmark rates stay the same, or the prospect of Fed rate cuts later this year is taken off the table?
Well, the main reason why stocks are falling, in my view, is that 40% of the index is the top 10 stocks that are really the Magnificent Seven. And they have such a big weight, and they are so sensitive in the risk parity models to what interest rates do. So if rates are now a bit higher and higher for longer, then, of course, the Magnificent Seven do tend to trend lower. So I think a very important answer to your question is that the Magnificent Seven and the tech companies make up such a big share of the index. So that's why we have seen some broadening out away from them. But the difference in performance between the tech stocks and the S&P 493 continues to be very important.
Torsten, you're talking about these tailwinds potentially from the policy in Washington, D.C., but how much do you think Trump is willing to expand the deficit?
Well, the Committee for Responsible Federal Budget scored what came out yesterday and found that it would increase spending by 5 to 11 trillion over the next decade. So in some sense, it all depends on exactly what comes through. And we will, over the next 6 months, have a lot of budget discussions, including culminating with the debt ceiling in June. So let's see where it all goes in terms of what the ultimate fiscal impulse will be. But it's clear that at least what came out yesterday did not point in the direction of fiscal consolidation, but pointed in aggregate in the direction of tailwinds to growth.
Let's talk about where we are right now. If you are just joining us, 12 minutes ago, the jobs report came in with a downside surprise on the headline number, 143 against an estimate of 175 on non-farm payrolls, but an upside surprise on average hourly earnings month over month, coming in at 0.5%, the estimate 0.3. Unemployment dropping back to 4% from 4.1. The estimate was also 4.1%. So that unemployment scare of the summer is over, dead and buried. The Federal Reserve, of course, was a little bit nervous about that and delivered 100 basis points of rate cuts across a number of meetings to close out last year. Now we're firmly on pause. We were talking a lot about the revisions for 2024. The average monthly gain has been revised to 166 from 186. And I think there were some economists who were looking for something a lot weaker than that.
Which is the reason why people are looking at this and saying, wait a second, we were expecting last year to have even less strength, and actually it was pretty strong. It just goes to undermine the fear that we had at the end of last year that caused those rate cuts by the Federal Reserve, and raises questions. Is this really a market that's so susceptible to cracks forming if there is a policy that hangs out there that creates a good deal of uncertainty?
Jeff Rosenberg of BlackRock joins us now for more. Jeff, you've had about 13 minutes to pore over these numbers. What's your big take, sir?
Jonathan, I think the big take here is January is a difficult month. There's a lot of moving parts. This is a mixed report. I think the conclusion remains the same. There's a very strong labor market. It's not going to change the Fed outlook. But probably the most interesting thing is the last thing that you said, that may be what the market is keyed on, which is the annual benchmark revisions. The market having expected a lot bigger validation of the story that the labor market is overstated in terms of payrolls. And the overstatement was not as overstated as people thought. And so maybe that's pushing up a little bit on the rate reaction. But overall, it's a mixed report. AHE, as Mike Collins and you guys highlighted, that's probably flattered by the reduction in the work week. The unemployment rate ticking down. That's on the strong side. And the payroll headline is a little bit disappointing, especially given the seasonal expectation that would give it a seasonal boost. Overall, I think you talked about in the earlier session about the asymmetry to the Fed. It's going to take a very, very strong report, and unlikely to come out of the labor report, but really an inflation report to push the Fed off of the cutting expectations. Whereas a weakening side, the Fed's going to be very quick to cut. I don't think this changes the outlook. We're still on pause here well through the first half of the year, and a lot more data is going to be necessary for the Fed to accelerate their pace of cutting, because they were very clear in highlighting in the FOMC they're in no hurry to cut.
Jeff, you talk about the asymmetry in the Fed's reaction function and their propensity to cut rather than hike if there is a weakening rather than some sort of boon. Is there an asymmetry in investors that needs to be rethought? That people really believed that this was an economy that was starting to show weakness, which justified some of the rate cuts that we saw at the end of last year,
that maybe that didn't really exist. Maybe that we actually had a much stronger labor market than people had expected. And this is a market that is more susceptible to overheating than some people gave it credence over the past few weeks.
Yeah, that's the change. You know, we had the fear on the labor market late summer, fall last year. That's been replaced by a debate. You started to get into it earlier around, really, are we that tight given how strong these labor markets are? And maybe the Fed doesn't have to move as far, and maybe neutral's a lot higher than we thought it was because of the performance, the strength in the labor markets, the strength in the economy, and the halting progress that we're making on disinflation. That's kind of the summation of the change that has really pushed us away from the Fed is going to push us into recession, the big increases in interest rates, much more towards what I keep saying on this program. You know, the Fed's ignoring the role of financial conditions and incredible wealth creation coming out of that Mag 7 AI wealth creation, wealth effect that is leading to much looser financial conditions than you would expect given the interest rate structure. And that's really, I think, the issue here is that financial conditions haven't been transmitting into the real economy as tight of policy as the rate piece. And the Fed and comparisons to the Taylor rule and interest rates are just missing the boat here that in a modern economy, really the post-GFC economy, it's financial conditions through which monetary policy transmits, not so much the interest rate. We're much less interest rate sensitive. We're much more confidence and spending sensitive, and that's driven by financial conditions.
So, Jeff, all of that said, when you put it together, would you fade the rally that we've seen over the past 4 weeks in the 10-year Treasury yield?
Well, you know, it's interesting you talk about the 10-year Treasury yield rally, and here we're talking about kind of before Fed and Fed policy. And obviously there's a disconnect here between talking about the rates on the short end, what the Fed is going to control, what the markets are going to react to with respect to the Fed, and what's going on the long end. And what's going on the long end is going to be much more affected by things like term premium, inflation uncertainty and inflation risk premium, and the fiscal policy outlook. So I think that we've gotten to a level of term premium that is normalized part way. You've gotten a lot better in terms of the term premium, and that's raised the attractiveness in terms of the 10-year relative to the 2-year. I think that fading it is not really the outlook right here. I think what you're going to be looking for is the debate around the next policy. You know, a lot of focus on trade and tariffs. We're going to turn that focus into taxes and fiscal, and that's going to weigh a lot on where that 10-year and that term premium settles.
And that's how you dance around a pointed question. Jeff Rosenberg there of BlackRock. Jeff, appreciate it, sir. Thank you very much. Following the payrolls report about 20 minutes ago, downside surprise on the headlines number, but a much hotter than expected wage print. Tease us up for next week. CPI on Wednesday. Also on Wednesday, you'll hear from the chairman of the Federal Reserve testifying in front of the House.
That could be more important than the number that we just discredited for the better part of the morning, and that actually is causing people to rethink exactly where we were. If you see an upside surprise, does that become a real move that unwinds some of what we've seen over the past month?
Reaction from the White House first, right here on Bloomberg, just moments away, about 15 minutes away. We'll hear from the National Economic Council Director, Kevin Hassett, so look out for that conversation in just a moment. Before we get there, let's get you an update on stories elsewhere. With your Bloomberg Brief, here's Yahara Hacker. Say, Yahara.
Hi, John. Recapping the payrolls report, the U.S. economy added 143,000 jobs in January. The median average in our survey had been calling for 175,000. Meanwhile, unemployment fell to 4%, and average hourly earnings, they rose 0.2% from a month ago to 0.5%. President Donald Trump has tasked his Vice President, J.D. Vance, with overseeing the future of TikTok in the U.S. Punchbowl reporting Vance will work with National Security Advisor Michael Waltz. On his first day in office, Trump issued an executive order giving TikTok a 75-day extension to find a buyer in the U.S. or face a ban. And the Kansas City Chiefs are looking for their third straight Super Bowl title. The Chiefs will take on the Philadelphia Eagles in Super Bowl 59 on Sunday. President Trump is set to become the first sitting president to attend the game in person. He posted on Truth Social this morning saying, "Two great quarterbacks in this game, also an unbelievable running back, and the absolute best tight end in football ever." He sounds excited. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead, sneak peek of next week as well, and we'll count you down to our interview with the National Economic Council Director, Kevin Hassett. Kevin joining us in about 10 minutes' time. The equity market is totally unchanged on the S&P 500. Your trading diary for today and into next week looks a little something like this. This afternoon, President Donald Trump meeting with the Japanese Prime Minister. Look out for that on Tuesday. You'll hear from the Fed Chair Jay Powell testifying before the Senate. You'll hear him testifying before the House as well next week. The Wednesday morning will be dominated by the CPI report. On Thursday, another round of jobless claims. And on Friday, a retail sales report. Coming out in about 5 minutes' time, walking out of the White House, you'll see Kevin Hassett, the National Economic Council Director, joining this program first, right here on Bloomberg Surveillance. And I think we've all got the same question, Bramo. What would you ask Kevin Hassett in 5 minutes' time, Torsten Slok?
Well, ask what the view is on the economy going forward, ask on the view on what fiscal policy is going to do and what tariffs might do and what that might mean for the outlook.
And how complicated life might become if we can't get those tax cuts from this Congress.
At a time when a lot of people are baking that into their projections, at the same time, does this administration have more room to take their time if this is an economy with plenty of heat behind it, so it isn't necessarily at risk of cracking?
I like what Chris Verrone said at the top of the show. What is the pain threshold for these policies? That 10-year yield that Scott Bessent, he said Donald Trump is so focused on this time around, how high can that get where it's going to push back on all your fiscal policy plans?
You think we'll get a yield target out of Kevin?
Most likely.
525.
525. Are you kidding?
525.
You think that that's what he's going to say?
525.
Yeah, all of a sudden, I'm sorry, Kevin Hassett cannot join us. Absolutely not. It'll be 3.5%.
We're getting a yield target from Kevin. Kevin Hassett just around the corner.
Zero.
If you're just joining us, the jobs report came out about 25 minutes ago. Came in at 143. That's the headline number. The estimate was 175. Headline number a bit softer than expected, but the details hotter than expected, particularly earnings. Wage growth coming in at 0.5%. The estimate was 0.3. The equity market pretty much unchanged. The opening bell 34 minutes away. Kevin Hassett, the National Economic Council Director, live from the White House, up next.